Okay, so then onto my topic. As I said, I sit in banking and finance, and so financial services regulatory is one of my specializations. And then, of course, with the sustainability angle, I'm very interested in sustainable finance and the different financial products and services that are offered under those auspices. And so I've been watching quite carefully the regulatory and policy changes that we're seeing coming out of the FSCA, as well as internationally. And so what I'm going to do today is just take you through some of those. So I thought I'd start with this idea of, will we get left behind in the quicksand? Because what we often hear from clients in this space is that there is so much regulation. Even putting sustainability aside, there is so much regulation for people in the financial services industry to deal with, and there's so much change. If you then add on top of that the regulatory developments, not just in South Africa, but in other areas of the world, if we think of the European Union, for example, and the impact that those regulatory developments have on our system in South Africa, it can become really overwhelming. So you can be hit with this inertia of there is so much regulation. How do I prepare my business? What do I do? What do I even think about? And so oftentimes when we talk to clients about future changes coming or policy direction that we see the regulator taking, sometimes the answer is, we'll think about that when it actually becomes law. Please don't talk to us about it until it's actually law, because otherwise it's too much. The difficulty with that response and with that thinking is that you may very well get left behind in the quicksand. You may not be able to adapt your business or your business operations quickly enough to meet the legal changes if you wait until that moment to shift from business as usual. And so I'd really like to encourage all of you today to think about that when you consider draft legislation coming out of the FSCA or the Prudential Authority, or when you engage with COFI. We always talk about COFI, and who knows when we're going to see COFI. I had a secret hope that it might be promulgated quickly before the elections, but that hope is dwindling. But when you engage with legislation like that, that seems far off, do just consider the impact that it could have on your business, and the fact that you may need quite a long transitional run-up period, longer than the transitional period actually provided in the legislation, so as not to get left behind in the quicksand. So it could look like this, or feel like this feeling of drowning and too much regulation, and therefore I don't want to look at policy changes as they come through. Or it could feel like this, a more positive feeling of stepping out of the quagmire that we find ourselves in and actually trying to adapt. So where are we now? This little table is an excerpt from the FSCA's Statement on Sustainable Finance that they put out in March 2023. They have subsequently put out an update, which I'll talk to in the later slides. But when this came out last year, March, it was actually the first time that we could see in a policy paper from the regulator where they were going with sustainable finance and what they felt their role would be in driving change and regulating for change. So this table sets out the 5 pillars that the FSCA identified as the areas where they, as a conduct regulator, would need to intervene. You'll see taxonomy, disclosure reporting and assurance, market development, active ownership, and consumer education. And then in the rows underneath, that was how they felt they were going to do it. So undertaking capacity building, research, and then that's so the first 2 rows are the initial stages, and the FSCA spoke about the initial stages being the immediate future, which they spoke about being sort of a 2-year period. And that's, I guess, the period we're in now. So you'll have seen requests for information come out of the FSCA. You'll have seen the FSCA gearing up their capacity, bringing in consultants where they need to, and making sure that they understand these issues appropriately. And then the idea is to move on to the next 2 rows, where there is actually regulatory and supervisory framework development, and that's the most important part for all of us, because that's where the actual law comes and where those changes come through. So I've thrown some words around this table just to show you that actually in the short time since this statement in 2023, there have already been some developments that sit in under these pillars. So we know last year around June we saw IFRS S1 and S2 being finalized and being published, and some of my colleagues will speak a bit more about that later. But we know that SAICA and the JSE and many companies in South Africa are really supportive of the adoption of IFRS S1 and S2. And if IFRS S1 and S2, of course, represents a convergence of all of the voluntary standards that we've seen to date. That convergence is really important because once you have convergence, then it's much easier for a regulator to step in and start making things mandatory or start making requirements against a common standard. When we were maybe 2-3 years ago and there was no convergence, then regulation, particularly from a South African context, was a bit further off than it is now. Some of you would have seen the voluntary carbon market launched. That would fit in on the FSCA's plan under market development, and the FSCA have been quite vocal about trying to support the voluntary carbon market. National Treasury's green finance taxonomy that we've had for a few years now, there's a big focus on trying to really embed that and require alignment and use of the green finance taxonomy. And then we saw CRESA 2, which fits in under the active ownership pillar as a voluntary standard encouraging active ownership and stewardship. So there has actually been quite a lot of movement, quite a lot of development, albeit that of all of these things on the screen, VCM, CRESA, Green Finance Taxonomy, IFRS S1 and S2, none of these things are mandatory. None of these things are actually hard law that you'd want to, if you were going to wait until something was hard law, you'd be ignoring all of these things still. In the latest sustainable finance statement that the FSCA put out in March this year, so the 2024 one, you will see the FSCA confirming again that they see their role as a conduct regulator as being vital and pivotal. And where they wish to focus their role, at least initially, are on the first two columns, the taxonomy, disclosure, reporting, and assurance. And that is because they think that the foundation or the bedrock of regulating sustainable finance and regulating sustainability in a financial services sector space is ensuring that there's credible and consistent information. So what does that signal to all of us? It signals that we should be paying attention to IFRS S1 and S2. We should be paying attention in the way we do all of our operations to any of the voluntary disclosure mechanisms that may be relevant in a South African context, because the indications are that we are going to move to a more mandatory disclosure and reporting regime. So if I just break those, this one, disclosure, reporting, and assurance, the second pillar, down into a table, you can see it's really got three elements to it. And each of these elements could have quite a big impact on the way that business happens in a financial services space. So there's reporting at a corporate entity level, and that's the first column on my table. And already we've seen the development there. So we've seen the JSE put out their voluntary guidance on how to make disclosures against climate and against sustainability more generally. We've obviously seen the taxonomy. We've seen efforts being made by certain financial institutions to align to the taxonomy. So to actually be able to say, my portfolio is X% taxonomically aligned. IFRS S1 and S2, as I've mentioned, has been very quickly, is finding its way and embedding itself into our system. And all indication is that it will be adopted soon in the same way that IFRS 4 general accounting has been adopted. And we've seen the Prudential Authority put out guidance to banks and insurers on how they can make disclosures again against climate and sustainability. So there's been quite a lot of movement in that corporate entity disclosure reporting state. And that's, of course, at the company level. So from a financial services perspective, that's where we're looking at investing into a company. What is the information we want to get from that company? If we are a financier providing financial products to a company, what is the information we should be able to rely upon coming out of that company when we make our own assessments as to whether that company fits into our strategy or not? The product disclosure column is a bit more nascent still and less developed. The product disclosure column talks to things like we've seen in Europe, where a particular product will need to be disclaimed in a certain way when sold to the market. So if I want to call my fund that I'm selling to members of the public green or sustainable or impact focused, I would need to meet certain requirements in order to make those claims. And of course, product disclosure is really important to a conduct regulator, because the conduct regulator is very concerned with treating customers fairly and avoiding mis-selling. Now, there is a huge risk, at least the FSCA thinks so, and they've said so in their report, there is a substantial risk that customers in this space could be confused, could be misled, and could end up investing in a product because it's been sold to them in a certain way, when in fact that product is not what it seems. And that's a big concern for the regulator, albeit that yet we haven't seen too much development in moving towards a product disclosure regime, but it is something on their radar. And then linked to that is disclosure to retail investors, so making it clear to retail investors when a particular product is sold to them or a service is offered to them, what that means and what they can expect from that interaction. Underlying all of this, you'll see it in my last row, is assurance. Obviously, assurance is critical if one wants to be able to trust or have to trust the veracity of the information that's being put out there and to externally verify that information. And that's of course important if we just go back to this idea of having credible and consistent information. So the FSCA has been looking into credit rating agencies and other service providers in the space who may be able to offer and to bolster assurance. Sometimes I think it's easier to think about this from the perspective of the customer, which all of us are not, we all come at these problems usually from the perspective of the professional, the service provider, or the business that's offering the financial product or the financial service. But if you think about it as a customer, would you be comfortable when making a buying decision as to which financial product to invest your retirement savings in, for example? Would you feel comfortable that you could understand why the product being offered to you as a green product is more sustainable than the product you already have? If a financial advisor is saying to you, shift your retirement annuity from these underlying funds into these green funds, would you feel confident that actually that shift was having the positive impact that you were hoping to have by allocating your capital in that way? Would you know what the questions are that you should be asking your financial advisor? Would you know what the risks are, the transition risks, for example, of having a investment portfolio heavily exposed to oil and gas? Would you know what the questions are that you should ask your financial advisor or your asset manager, make sure are in your investment restrictions to be sure that those risks are covered off? And are we actually able to see the wood for the trees? There's so much out there, there's so little consistency. Is it possible as a consumer, retail customer, to really understand what the different options are on the table and then make an informed decision? And of course, because we don't have at the moment credible, consistent reporting, can we really compare apples and apples? So this is a bit of a summary of the main risks that both the FSCA have identified and IOSCO have identified as well. These are the risks that conduct regulators around the world are worried about, because this is the position that financial customers are in. Now, if we think about it from that perspective of how does a financial customer feel, what are the risks that are facing a financial customer, it gives us good insight into what are the stopgaps or the plugs that a regulator is likely to put in place to protect a customer in these instances, and what are the things that we as businesses interacting with customers and either selling customers services or goods or financial products, what are the things we need to be thinking about to address these pain points? So against that backdrop, where are we going? What can we learn from the Financial Sector Conduct Authority's 2024 statement? So we know that the FSCA is going to continue to encourage the highlighted voluntary adoption of the green finance taxonomy. And it's said that it's going to do that in the period from 2024 to 2026. So there's not going to be an immediate requirement, a mandatory requirement to comply with the taxonomy, but the policy direction is that the taxonomy is here to stay, and that alignment with the taxonomy will be a positive thing because it will help businesses transition and get ready for a future where that may become mandatory. Everyone is still being very mum on whether or not that will become mandatory in future, so we all have to look into our crystal balls to see, but certainly all the indications at the moment coming both out of the FSCA and out of the Prudential Authority is that there is encouragement to financial sector participants to try and start working with the taxonomy, trying to find that consistency of information. When we say green project, this is what we mean, because it meets the requirements of the taxonomy. Not to say that taxonomy is not is foolproof. It's also not complete. It's a process, and further inputs, further taxonomies will be needed for it to be complete. But it is a good starting point for any business wanting to check what is the yardstick or the benchmark against which I may need to test the project in order to tell if it meets at least the green requirement as per the current taxonomy. And the FSCA have, perhaps stating the obvious, but the FSCA have made the point and put this sentence into their statement on sustainable finance, that they believe that the taxonomy can support capital flows. So whether that be international capital or local capital into the correct projects, correct in inverted commas, meaning green projects, projects that have a positive environmental impact and do not do significant harm. Particularly if we look at the LMA, the Loan Markets Association, of course, sets out principles that are applicable to green loans, social loans, and sustainability-linked loans. And the LMA, being a global market body, doesn't make regulation for specific jurisdictions. It rather sets up principles that are then used in a jurisdictional specific way by participants in a jurisdiction. And one of the indications that the LMA has made is that if there is a taxonomy in your jurisdiction, you should have a look at it as a financier, particularly when you're trying to decide whether a particular project is green or not. Don't set out green criteria that are completely divorced from an existing taxonomy in the jurisdiction. So I think that also underscores the relevance of the taxonomy and why we should be engaging with it. Then both the Prudential Authority disclosure guidance that I've mentioned and the JSE disclosure guidance, both of those are based on or take inspiration from, the JSE disclosure guidance came out before IFRS S1 and S2 had been finalized, but it is based on the early exposure drafts. And the Prudential Authority's disclosure guidance also is based on IFRS S1 and S2. So that, again, is the way that that's the direction of travel that we're going into when we think about disclosure and what is the content of the disclosure that we will need to make. And the FSCA have indicated that they would like to require voluntary disclosure, so still voluntary, not mandatory, but they would like to advocate for voluntary disclosure, and they'd like to publish their own guidance to apply to non-bank and non-insurance financial institutions, because currently the Prudential Authority's guidance only applies to banks and insurers. The FSCA is suggesting that they will issue similar guidance for other financial institutions. And again, they say they're going to start with retirement funds. That makes a lot of sense because we know that already in Regulation 28, retirement funds are required to consider ESG factors in their investment decision making, and they're required in their investment policy statements to indicate how they do so, and to also report to members if they make an investment that doesn't take into account ESG factors. So there's already a level of disclosure and reporting required by retirement funds. So the FSCA has said they're going to start there when they start thinking about the guidance that they wish to publish for non-bank and non-insurer financial institutions. They're also going to put out a joint standard on culture and governance. This has also been in the works for a while, and to my mind, this is very much tied to COFI, the fate of this joint standard. But having said that, we've seen the joint standard on cyber resilience come out without COFI, so maybe the joint standard on culture and governance, which will be based on the King Code, could also be published in anticipation of COFI actually being promulgated. And then they have stressed that they are thinking about a product level disclosure requirement. Obviously that, as I said, is quite nascent and not fully formed yet, but it is useful to know that they are thinking about that. And I've lost my ability to click. Let me just try this. There we go. So really the thought that I just want to leave you with before I call up my colleague James Brand to talk a little bit about biodiversity risk and development is that rather than get stuck in thinking that there's too much regulation to deal with, there's too much change to consider, rather see if you can change your way of thinking about it and engage with these policy indications as and when they come out, and think about what that means for your business so that you can, in fact, be prepared to be part of the new regime that we're all moving into as financial sector participants. So thanks very much. That was your first 20-minute micro.
Okay, good morning. Risks around climate change are generally understood. There are few companies out there today that don't have a climate strategy or in some way dealing with the risks posed by climate change to their business. But this wasn't always the case as we collectively transitioned from questioning whether climate change exists to largely accepting that it exists and understanding its relevance, to moving on to assessing its materiality for risk and opportunity, and then finally disclosing on that materiality. But until recently, companies could decide whether to disclose information about their greenhouse gas emissions and how climate change might affect their business plans. But this is changing rapidly. A suite of new laws, most notably in the EU and US, will soon make climate-related disclosures mandatory across much of the global economy. Once all pending disclosure rules in the US are in force, it's estimated that they will cover nearly 40% of the world's economy. We can anticipate this trend to continue in other jurisdictions as well, as transition risk relating to disclosure bites. This is great for investors, as it gives them greater transparency to allow them to make better informed decisions about a material risk that assists in informing their capital allocations when it comes to climate. In South Africa, we do not yet have mandatory climate disclosures, but we're likely to follow international trends on this. In this presentation, we won't be talking about climate change, as these issues are generally well understood. Instead, we'll be talking about something else that is currently largely a blind spot for most companies, and that is biodiversity. And in the title to this presentation, I've taken a phrase from the WWF, and we'll be suggesting that we need to get out of our collective first gear and start shining a light on biodiversity issues. In so doing, I'll draw parallels with the climate journey that we've been on, as biodiversity is taking a page out of the climate change book and is tracking a similar path and is catching up to climate as a potential material consideration for both corporates and investors. So first, what is the problem? The great acceleration of the global economy over the last 70 years has boosted average income and life expectancy. However, these benefits have not always been equally shared and have come at a great cost to our natural systems. With regard to these natural systems, the planetary boundaries are a scientifically accepted means of measuring these natural systems and were first proposed by 29 internationally renowned scientists way back in 2009. These are the 9 Earth system boundaries that scientists have identified that we need to stay within to maintain the stability of life as you know it and avoid triggering tipping points that will irreversibly destabilize the Earth system. As you can see from the slide, over time we've moved to a point where we are now exceeding 6 of these 9 planetary boundaries, including the planetary boundaries relating to biodiversity. In the climate change space, the Watershed International Agreement that mobilized action around climate change was undoubtedly the Paris Agreement of 2015. The equivalent in the biodiversity space is the Kunming-Montreal Global Biodiversity Framework, or GBF, that was recently agreed in late 2022 by over 196 countries, including South Africa, and is a significant development at an international law level to address these biodiversity-related exceedances. In the preamble to the GBF, this international law document provides that an average of around 25% of assessed species in the animal and plant kingdoms are threatened, and that around 1 million species already face extinction, many within decades, unless action is taken to reduce the intensity of drivers of biodiversity loss. The GBF provides that the global rate of species extinction is already tens to hundreds of times higher than it has averaged over the last 10 million years, and that biodiversity is declining faster now than at any time in human history. And while species extinction is a natural feature of life on Earth, as species have come and gone since the beginning of time, it's the current pace of our biodiversity loss and its decline that is the issue. So what is the relevance of all of this to investors, you might be asking? By losing these individual species and degrading their habitats, and we weaken the unaccounted for ecosystems and the ecosystem services that nature provides us. Ecosystem services are the direct and indirect contributions that ecosystems provide the economy. Last year, the PwC published a report suggesting that more than half of the world's GDP is moderately or highly dependent on nature. All 163 economic sectors analyzed by the PwC had a portion of their value chain that is highly dependent on nature. They found that more than half of the market value of listed companies on 19 major stock exchanges are all exposed to material nature risk. According to recent reports published by the European Central Bank, 72% of European companies are dependent on at least one of nature's services, and these findings are likely to be relevant to other jurisdictions as well. So what are the real-life examples we can use to get our heads around how losing species and ecosystems can impact the global economy? A useful first example is that 35% of the world's food crops depend on animal pollinators to reproduce. That's 1 out of every 3 bites of food that you eat. Without functional ecosystems, we would need to manually pollinate key crops ourselves, making our food production unviable, with obvious consequent knock-ons to the agribusiness, food and beverage sectors. The pharmaceutical sector is also exposed, as approximately 50% of prescription drugs are based on a plant-based derivative, and approximately 70% of cancer drugs are nature-based. Biodiversity loss is also linked to increases in disease, as humans encroach into untouched nature through deforestation and urbanization. An estimated 43% of emerging infectious diseases come from wildlife that we previously had no or very limited contact with. One just needs to look back to the recent COVID pandemic to remember the impact this had on the global economy. Other examples include a phytoplankton bloom fueled by excessive nitrate runoff from over-fertilized fields, jeopardizing Baltic fisheries. Coffee production is declining in countries that account for 75% of Arabica coffee supply as a result of soil degradation, disease, and increased warming. And similar findings exist for other crops. Scientists also highlight that the removal of our functional ecosystems that redirect or absorb stormwater give rise to infrastructure damage in the extractive sectors and real estate sectors, and we see that in our own practice here in the Environmental Law Department. A report by the World Resource Institute, published on the 4th of April 2024, concluded that in 2023, we lost the equivalent of almost 10 soccer fields of tropical primary forest per minute globally in the period of 1 year. So the indicators are still, unfortunately, tracking in the wrong direction. The bottom line is our economy relies on nature. Destroying nature means destroying the economy, and that is a problem and is of relevance to investors. But is this risk being assessed and disclosed to allow it to be priced in by investors as per the image on the slide? So realizing there's a problem and realizing its relevance, I'd like to touch on just 4 key developments in the bioeconomy which are worth watching out for. The first relates to disclosures. The reality is, without adequate disclosures, it's not possible to accurately price in the risk of biodiversity loss, as you don't know what you don't know. According to a report by Morningstar of January this year, companies with higher biodiversity risk are currently systematically overpriced. Target 15 of the GBF, the Paris Agreement for Biodiversity that I mentioned earlier, encourages large companies and financial institutions to assess and disclose on biodiversity risk. Related to this, we see the Task Force on Nature-Related Financial Disclosures, or the TNFD, recently released their framework on biodiversity disclosures in September last year. In many respects, this is the little cousin of the TCFD, which is the Task Force for Climate-Related Financial Disclosures that we are now familiar with in the climate space. And as we've seen significant uptake in disclosures against the TCFD globally for climate, we can anticipate similar uptake with the TNFD for nature-related disclosures. By disclosing in this manner, there will be greater transparency on nature risks, which is great for investors. And off the back of the increase in prominence and awareness of the TNFD and the need for disclosures to understand exposure to risk, like we saw with climate historically, we are seeing shareholder activists bringing resolutions requiring disclosures on nature against the TNFD, with Starbucks, PepsiCo, and Kellogg's owner Kellanova, all being subject to such filings by shareholders already this year in the US. So like we saw with climate, we can expect demands from stakeholders for nature disclosures, and like we've seen with climate, we can anticipate the move from soft law obligations on disclosures to hard law mandatory requirements in due course. We're already seeing this in Europe, as starting from this year, approximately 49,000 European companies are required to report on biodiversity and ecosystem-related risks in accordance with the Corporate Sustainability Reporting Directive, or the CSRD. It will not be long before nature catches up to climate in other jurisdictions as well when it comes to the emergence of global mandatory disclosures. So where does all of this leave directors and their fiduciary duties? Earlier this year, on the 11th of March, a legal opinion was issued by the Commonwealth Climate and Law Initiative in respect of director duties with regard to biodiversity risk in terms of the laws of England and Wales. The opinion concluded that depending on the facts of a particular matter, directors who fail to give consideration to relevant material nature-related risks and fail to take appropriate steps to mitigate them may be exposed to claims that they have acted in breach of their fiduciary duties. Although this opinion is limited to the laws of England and Wales, we can expect similar opinions and similar applications of this opinion in other jurisdictions. The opinion identified that the starting point for any director is identification of the extent to which a company faces nature-related risks. For example, imagine a company that manufactures aeroplanes, the tires of which are made from a specialized form of rubber that neutralizes electricity created naturally through friction on landings and takeoffs to avoid damage to the airplane's electrical components. Almost all conductive rubber in the world is sourced from a single species known as Hevea brasiliensis that is grown at scale in tropical Asia. Scientific research has estimated that if a single parasite that is specific to this single species of tree spreads to Asia, the entire global production of conductive rubber could be wiped out within a decade. This would cause massive interruption to the entire aviation industry and large losses to its investors. The dependency on a functional rubber ecosystem service could therefore be viewed as a possible material risk item in this example. And this example can be extrapolated to other sectors as well, as rubber trees supply 90% of the world's rubber, which is used in approximately 40,000 products. So the aviation industry is just one of the many sectors that are dependent on the rubber trees ecosystem. So as a director of a company, you'd want to start by looking to identify the nature-related risks facing your company, and then once these are understood, assess which of those risks are relevant and material. A failure to do this may expose directors to claims that they've acted in breach of their fiduciary duty. The third development worth touching on is the emergence of the biodiversity economy. In this regard, Target 19 of the GBF provides that if we are to halt our extinction rate, an additional 700 billion per year is needed to safeguard biodiversity and conserve ecosystems leading up to 2030. 500 billion per year will be achieved by phasing out harmful subsidies, most notably in the agribusiness sector, leaving 200 billion per year being required by 2030. As of February this year, we had raised just over 214 million of the required 200 billion, woefully short of these targets. So the challenges we see in the climate space when it comes to mobilizing the required finance at state level, we see repeating in the biodiversity space as responsible governments are slow to step up. But like Article 6 of the Paris Agreement, that recognizes the role the private sector has to play in mobilizing climate finance through a variety of channels, including the carbon markets, we see Target 19 of the GBF for nature anticipating the same thing, with mention of the need for the private sector to invest in biodiversity, including through, among other things, biodiversity offsets and credits. In this regard, the voluntary biodiversity credit market shot out the blocks post the signing of the GBF to help bridge the biodiversity funding gap with a massive activity on the supply side of this emerging market. But this is not translated into more than a handful of transactions, as there's still a lack of demand side uptake from companies in the absence of regulatory drivers for such a demand. But it's still very early days, and it can be expected that as disclosures on nature become mandatory, like we're seeing with climate, corporates will be under pressure to demonstrate their net positive biodiversity status, fueling the demand for biodiversity credits going into the future. In South Africa, earlier this year in March, our Department of Forestry, Fisheries and the Environment published a draft document titled National Biodiversity Economy Strategy. Of potential interest to financial institutions is the reference in the document to the future development of new financial instruments to fund conservation, as well as developing a strategy around natural capital accounting and payment for ecosystem services. Although very broad in nature, this policy document is an apparent first step towards domesticating the GBF and some of its targets. We can anticipate the building out of a regulatory framework for the bioeconomy over time. And then finally, cross-border initiatives from trading partners like the EU is something we are familiar seeing in the climate space, with things like the Carbon Border Adjustment Mechanism, or CBAM, which seeks to penalize trading partners who produce goods in carbon-intensive economies. In the biodiversity space, we see a similar pattern with, for example, the EU Deforestation Regulation, or the EUDR, which comes into operation later this year on the 30th of December. It's designed to promote deforestation-free supply chains. Companies will only be allowed to sell certain listed products, such as beef, coffee, and palm oil-derived products, among others, into the EU if the supplier of the product has issued a so-called due diligence statement confirming that the product does not come from land that was deforested after the 31st of December 2020. Earlier this month, the Australian government asked the EU to delay the implementation of this regulation, outlining their concern as regards their beef export to the EU arising from land clearing for cattle in New South Wales and Queensland. Recently, 8 US wood-related trade groups also approached the EU requesting a delay in the implementation of these laws. Exactly how these laws will impact Africa and South African exports is yet to play out, but like we see with the CBAM, Carbon Border Adjustment Mechanism, in the carbon space, we can expect more cross-border themes emerging in the biodiversity space as well. Finally, the image on this slide is taken from the World Economic Forum's Risk Report of 2024, and you'll see risks relating to biodiversity loss and ecosystem collapse being rated third behind critical change to the Earth systems that we spoke about earlier coming in second, and extreme weather events arising from climate on the top of the list. Fortunately, how we approach climate change has provided us with a playbook as well as many learnings. As a result, we can expect biodiversity developments to evolve quicker than we saw with climate, and we can expect it to move rapidly up the corporate agenda as it catches up to receive equivalent attention alongside climate. In my view, the signing of the GBF was our collective click out of neutral and into first gear, and we can expect the global economy to react quickly from here as we shift through the gears to meet challenges that we face around biodiversity. Thank you.
Thank you. Yeah, you heard my name, Magda Snickers. I'm in the tax division, and I'm going to talk about tax to you today. And I'm sure you guys hear the word tax and you think, okay, now's the time just to sit back and have a quick nap, before the next exciting topic. I don't blame you. Tax is normally a thing we dread to think about. Tax is money spent, and you don't really see the benefit or the return on your money. But I like to talk about tax in the biodiversity protection environment because we can use tax to actually save the earth. We can spend money on projects that protects biodiversity, and we claim incentives for spending that money, and we reduce our tax bill. So in a way, tax can save a variety of life forms on this earth. So, and ESG, I'm passionate about it. I don't know that much about it. It's a new area of interest for me. I know a lot about tax in the financial services industry, but it's quite exciting to see how we can combine these two. When we look at what tax incentives are available, and how do we put that into a product where you can make money out of. So I'm hoping to give you a broad overview of the tax incentives that are available for biodiversity protection and renewable energy infrastructure. I'm hoping not to bore you with too much detail on these incentives because Some of them, are, the details are endless. So it's going to be a high-level overview. And then I'm going to be, at the end, just talk a bit about, financial products that could work in this environment. And I'm hoping in this way to make talking tax a little bit more exciting. I think before I start, it's just important to understand when we look at incentives, where do they fit in your tax calculation? Normally you would start and you would say, what is my gross income? And from gross income, you deduct amounts that are exempt from tax, and you get to what we call income. And then you claim your deductions and get to taxable income. And at the level of taxable income, you would actually calculate your tax. And then you'd sit with a number of tax payable that you can credit tax credits against and reduce it even more. Now, the incentives that I'm going to be talking about, they fit in at the level of deductions. So they give you a deduction. And normally, when we look at deductions, we say, do the deductions that we want to claim qualify for the general deduction formula? And this formula is in Section 11A of the Income Tax Act, read with 23G. And what it does is it requires a couple of things to be present before an amount can be deducted for tax. And one of them is that you need an amount, expenditure actually incurred in the production of income, and that would be income that's not exempt from tax. So by way of an example, if you acquire shares in order to receive dividends, dividends are typically exempt from tax, so then you cannot deduct your expenditure incurred in acquiring the shares, because you incurred the expenditure to produce tax-exempt income. So you need income that's not exempt, and the amount that you spent must not be of a capital nature. So this one's a little bit more difficult. So when we look at expenses, something that you spend to enhance your income-producing activities are not of a capital nature. But if you spend money to enhance your income-producing structure, for instance, the previous example, the shares, that would be of a capital nature, and you wouldn't be able to deduct it. And then lastly, you normally need to show that you are spending the money for purposes of trade. So if you've got can tick all those boxes, then it qualifies for the general deduction formula, and you don't need an incentive. You can just claim the deduction. But incentives typically are required because you do not meet all these requirements. The amount is not in the production of income, or you're not carrying on a trade because you're a passive investor. Or it's of a capital nature. Often it's of a capital nature. That's your biggest stumbling block. So the Income Tax Act has got specific incentives to provide taxpayers with deductions which they normally wouldn't be able to claim. So the first set that I'm going to talk about are the ones that protect biodiversity, and those are in sections 37 capital C and 37 capital D. These are they're called available tax incentives for conservation and sustainable land use. And section 37C has got deeming provisions. It deems certain expenditure that are incurred in the conservation of land or the maintenance of land to be in the production of income and to be incurred for purposes of trade in certain instances. There's two requirements. It needs to be in terms of a biodiversity management agreement of at least 5 years, in terms of section 44 of the National Environmental Management Biodiversity Act. So there's like a bilateral agreement that you need. And the land must be used for purposes for production of income, or it must be in immediate proximity to the land that you use for producing your income, so adjacent land. And the one example I think here where this could be applicable is if a taxpayer builds a lodge on a game farm, and as part of that he destroys some of the biodiversity because of the infrastructure that's put in place, the roads that they build. Then the taxpayer can conserve or maintain an adjacent piece of land by planting the relevant species in terms of the biodiversity management agreement on that adjacent piece of land and claim this incentive. This one, the deduction is limited to your income that you produce, so you can't create a loss with this incentive. And if you are in breach of the agreement, then there's a clawback, which is a sanction. So, it's a way of keeping you on your toes and make sure that you comply with your biodiversity management agreement. There's another provision in Section 37C that deals with where there's a declaration that has a 30 years duration. In terms of the National Environmental Management Protected Areas Act. So again, you need, just like a bilateral agreement again. Then the money that you spent on conservation of land, it's deemed to be a donation, and you can deduct 10% of your taxable income, or up to 10% of your taxable income, because this specific section, it deems it to be a donation, and you would claim the deduction under Section 18A, which is the one that deals with donations that are deductible. The other section that deals with protecting biodiversity is Section 37D. That's an allowance for declared land. So that's land owned by a person, and then it's declared to be a national park or a nature reserve in terms of an agreement with the Environmental Management Protected Areas Act. In this instance, if the title deed is endorsed to reflect a 99 years, then you can claim a deduction that is, it's the higher of 4% of the cost of acquisition and the cost of improvements, but it excludes borrowing costs, or 4% in terms of the formula, and that's where the market value or the municipal value of the land is lower than the actual cost and the amount spent on improving this land. So this can give you a deduction for more than what you've actually spent, but it is 4% a year, so it's not that substantial, but nonetheless there is a deduction for that. Those are the ones that specifically deal with biodiversity protection. I'm now going to move on and just touch on the renewable energy infrastructure and solar deductions. And these are in Section 12B and 12BA. Now, 12B has been in the Act for a number of years, I think at least 10 years. So it gives you a deduction for machinery or plant or implements, utensils, articles used in the production of renewable energy. The taxpayer must be the owner of this asset. It must be brought into use for the first time by the taxpayer for his trade, and it must be used for the generation of electricity from wind, photovoltaic, solar energy, hydropower or biomass. And then your deduction is, it's spread over a 3-year term. It's 50% in the first year, 30% in the second year, and 20% in the third year. And it's the lesser of the cost to the taxpayer or the arm's length price. So if the taxpayer can't highly inflate the price and then claim that, they would look at what is arm's length. What would you have paid in an open market if you were two parties negotiating at arm's length? This deduction has got some limits. There's a long list of them. I'm just going to mention one or two. If the asset was previously brought into use by a company that's managed and controlled by the same people that manages and control the existing taxpayer, then you can't claim this deduction. Or if you've claimed deductions in terms of Section 12E, which deal with small, medium enterprises, so then you also can't claim this deduction. So if you're looking at 12B, just be mindful there are limitations. But the exciting bit is Section 12BA, which is an enhanced deduction. This gives you 125% of your cost incurred for the acquisition of these assets where they're used for generation of electricity in South Africa. It's the same requirements as 12B, but this one's for a limited period. The taxpayer must bring the assets into use for the first time, or not after the 1st of March 2023, but before the 1st of March 2025. So you need to get into this one before the 1st of March next year, otherwise you wouldn't be able to use this. And as I said, it's exciting because it's an enhanced deduction. It's 125% of your cost. That's 12A and B, and then I'm just going to touch on 12L. This deals with solar incentives or deductions. This is more a deduction for energy efficient savings. So that's where, that's 12L. It's where any person in determining their taxable income from carrying on a trade. And this is only for years of assessment ending before the 26th of Jan 2026. So again, a limited period. You can get a deduction from income, but this one is a little bit more difficult because you need to register with SANEDI and you need a certificate from SANEDI, and they basically compare your energy requirements at the beginning of the year and what you've used at the end of the year, and if there's a saving, then you can claim 95% per kilowatt hour of energy efficient savings. So this is typically where, I mean, the very simple example is if you decide to replace all your halogen bulbs with LED bulbs, that's an energy saving. It's not the same as 12B and 12A, where you harness wind or hydropower to create energy. Here you need to implement measures to save energy. And as I said, it's a little bit more difficult because there's registrations and certificates and things required. But yeah, that's available until 2026. So those are the painful part is now over, all the detail of the various incentives. The last bit is I'm just going to talk a bit about financial products. So what can you do with these incentives? And because these are deductions, ideally you would want to give your investors the ability to claim these deductions. And how do you do that? You need a vehicle that gives them the ability to claim the deductions while making an investment. And the typical one would be a limited liability partnership. So you can get an investor investing into a limited liability partnership. The limited partners are seen as the owners of the underlying assets for tax purposes. The partnership is tax transparent. In terms of Section 23H of the Income Tax Act, the partners are deemed to be carrying on the trade of the partnership. So you've got the trading requirement dealt with. And then there's specific provisions in 23H that says that the limited partners can claim the deductions to which the partnership is entitled to, but it's limited. You can't create losses, but you can carry forward the excess deductions. So a limited liability partnership works very well in this space if the partnership actually owns the underlying assets. That would be the plant that I was talking about, or the machinery, or the utensils. Then the investors can claim up until the amount invested and the income that they receive from the partnership as deductions for income tax purposes. I think it also works for foreign investors. There are specific provisions in the Income Tax Act to ensure that a foreign investor that invests through a partnership are not actually taxed in South Africa. But in the context of ESG, I think often those provisions don't apply because you typically need, or they don't apply in the context of these incentives that I'm talking about, because you need to have taxable income, and that would be, it wouldn't be dividends or interest income in this instance. It would be other revenue that you produce from these assets. And non-residents would be sourced in South Africa, so it typically would be taxed in South Africa. So I think a foreign investor into such a partnership, would be able to claim this deduction because it would have it on the face of it a tax liability in South Africa. Yeah, and then other vehicles, I mean, these aren't, I don't know if they, can't really say they're appropriate for these circumstances, but I want to touch on them. We see permanent capital vehicles, those are companies. They're a little bit different because the permanent capital vehicle, the company would actually claim the incentives, so it would own the assets, and the investors would invest into shares in the company or advance loans, and the investors would either get a dividend return, which typically would be exempt from dividends tax if the investor is a company and it's a resident, but it could be subject to dividends tax if the investor is a non-resident or an individual or a trust. Dividends tax is levied at 20%. If interest is received, that's taxable income, but non-residents would be exempt on interest income, and they could potentially claim relief under a double tax agreement on the withholding tax on interest. The permanent capital vehicle would then be the entity claiming the deductions. It's taxed at 27%, so there could be some tax leakage. The last one that we would see in this context could be a trust. That I think could work well for resident investors, but not for non-residents, because we've got new rules trapping the income in a trust and taxing it there, and it's not flowing through like it used to in the past. So a trust would be could be appropriate for residents, but not non-residents. That is my presentation. I think I just want to conclude and say hopefully you've learned that there are a number of provisions aimed at providing incentives for protecting biodiversity and renewable energy infrastructure. Investors can benefit from these incentives by investing through tax transparent vehicles, and this way your money can be used to save the earth, and hopefully we'll all be here in future. Thank you.
Thank you so much. First of all, my sincere apologies for not being able to be there in person, but I'm very grateful to obviously all of you for come and joined us. These events aren't possible without you. So my apologies for not being able to meet all of you in person, but I hope that my voice from above will suffice for this presentation. So on that note, let me share my presentation and we can get started. So, as the name suggests, we're going to be talking today about blue bonds. But before we can talk about blue bonds and understand really what they are and unpack them, both the regulatory context behind them, how they're used, how they're defined, different taxonomies. Before we get there, we cannot discuss blue bonds without first discussing green bonds. So, what are green bonds, you ask? Well, generally speaking, green bonds are an umbrella term used for an array of sustainable finance instruments, all of which harness the power of debt capital markets to raise funds for projects that have a positive environmental, social, or sustainable impact. So when I use the term green bonds, it's the general term, and we'll unpack a little bit more about the different kinds of green bonds under that umbrella term. One of the distinctions that's drawn by both financial and legal practitioners alike is between two general categories or types of green bonds. Again, green bonds being the larger umbrella term. We have two separate categories. The first category is a use of proceeds bond. The second category is what we term a sustainability-linked bond, or an SLB. So under the umbrella term of green bonds, you've got your use of proceeds and your sustainability-linked bond. The main distinction between these two categories of green bonds really focused on how proceeds of the bond issuance are applied. So, when looking at use of proceeds bonds, as the name suggests, these are green bonds where there's a earmarked and utilized for a specific project or class of projects. For example, building a hospital or building a renewable energy plant. There's a specific project or class of projects for which the fund will be used. So those are your use of proceeds bonds. On the other hand, your SLBs focus less on projects, but more on the outcomes or targets, the environmental, social, and sustainable outcomes or targets, or KPIs, key performance indicators, which are set and aimed at by the issuer. An example of one of these KPIs would be the issuer decreasing their carbon footprint, lowering emissions, decreasing their reliance on fossil fuels. So, use of proceeds bonds, as the name suggests, where the funds go to what projects, and sustainability linked bonds, distinct from that, can be exploring projects, but the focus there being on outcomes and targets being met. So, for the remainder of this session, I'm going to refer collectively to these use of proceeds bonds and sustainability linked bonds that fall underneath the green bonds umbrella. I'm just going to refer to them as green bonds or sustainable bonds. The nomenclature gets a little bit tricky the deeper we dive. So, now that we have a picture in our minds of an umbrella term for green bonds and the delineation with the distinction between the use of proceeds on the one hand and sustainability linked or KPI focus on the other hand, the question then comes, well, what makes a green bond green? Or what makes a pink bond pink? What makes a blue bond blue? And so underneath, the second layer underneath this broad umbrella term, and how we delineate the different types of green or bonds as being green, blue, pink, it's largely dictated by, first of all, the purpose or initiatives for which the funds are being raised. In addition, we look at the intended effect or impact of those initiatives. So, as you may be able to guess from its name, or from the beautiful beach scene, which my brother took over the Easter weekend with his new drone, a blue bond, while still being a type of green bond falling under the umbrella term of green bonds, is a bond which is primarily focused on initiatives or outcomes related to the promotion of sustainable activities within the blue economy. What are these sustainable activities within a blue economy? What makes it blue? Well, we look at this, for example, at the sustainable use and protection of our water resources. Another example would be the protection of marine wildlife and ecosystems. So, to recap, we have a broad umbrella term for green bonds that encompasses broadly two categories. We've got your use of proceeds and your sustainability on the other side. Sustainability linked to KPI on the other side. Whether a bond is green, blue, pink, yellow will be determined by the purpose for which it must be raised and the effect or impact. And so blue bonds, again, as the last video suggests, has to do with our water resources, the protection of our marine wildlife. So, now that we have that, the first question then that comes to my mind is, well, who regulates and decides what makes a green bond green, or a blue bond blue, for that matter? What principles or regulatory framework is in place in order for us to regulate blue bonds around the world as all being of a similar nature and of having similar characteristics and adhering to similar principles? So, as we did before, diving straight into blue bond, we first discussed green bonds, and I think the same applies to a regulatory framework. One cannot dive straight to the regulatory framework of blue bonds without first fully understanding the regulatory framework in respect of green bonds, generally, in their many guises. So, the regulatory framework for green bonds or sustainable bonds around the world is continually evolving. There is a conference by the International Capital Markets Association coming up in a few months, and it's a conference based on principles that I'm going to talk about. But one of the points, key topics of the conference is going to be, are we not over-regulated? So there's a lot of regulation out there, it's continually developing, but where do we start? we start with ICMA, or the International Capital Markets Association, their principles. So it's the ICMA principles for short. The long term would be green, social, sustainability, and sustainability linked market principles. But obviously, for the sake of this discussion, I'm just going to refer to them as the ICMA principles. So these are published by the International Capital Markets Association, ICMA, and these are the university accepted standard for what makes a green bond green. Now, when I say they're university accepted as a standard, so much so that these ICMA principles are referenced in over 98% of all sustainable or green bond issuances internationally. A market representing nearly $4 trillion worldwide. So 98% of bonds refer and reference back to these ICMA principles. So they really are your starting ground, they're your beds, where we begin from. And so one of the ICMA principles that I'd like to talk about and expand upon a little bit is when we're looking at a use of proceeds bond, as discussed earlier, a bond where the use of proceeds is what drives the bond issuance, makes the bond green. So for use of proceeds bond, the ICMA principles have set out 4 core requirements for a bond to be classified as a green use of proceeds bond. And these 4 core requirements in the ICMA principles are obviously use of proceeds, perhaps the first and foremost. The use of proceeds needs to be for eligible green projects, i.e. projects that provide clear environmental benefits. What would these be? Well, clean transportation or electric vehicles, as an example, investing in renewable energy such as PV and wind, retrofitting buildings to make them more green and more energy efficient. So there's use of proceeds. It's important, and understandably so for use of proceeds. That's your first requirement. What the funds are used for. The second is how the issuer determines what projects are sufficiently green and what environmental or sustainable objectives are going to be achieved by these green projects. And what this requires is that the issuer is to provide sufficient detail as to the environmental and sustainability objectives of each green project. And essentially it needs to detail the process by which this issuer determines whether projects fit within their scope of green projects or whether they don't. So, to recap, the first 2 core principles is use of proceeds. The second is project evaluation, what projects we actually look at. The third is critical, management of proceeds. So, for use of proceeds one, the funds from the proceeds needs to be stringently managed, tracked, and restricted to ensure that funds only go towards the projects that they're supposed to go to. An example of how this is achieved would be by separate bank accounts. And finally, and very important for a discussion we'll be having shortly on greenwashing, the 4th core requirement for use of proceeds bond and ICMA principles is reporting. Continual reporting and auditing requirements on the flow of funds from the proceeds of the issuance and the use of those proceeds both prior to issuance and throughout the life of the bond. As I said, this is critical for mitigating claims of greenwashing and mitigating the risks of greenwashing, which we'll touch on in a few slides' time. So, we have ICMA principles. And it may also be worth noting that the JSE, the Johannesburg Stock Exchange, and their criteria for listings or debt listings on their sustainability system include compliance with approved principles, such as the ICMA principles referenced above. So the JSE themselves also require compliance with these ICMA principles for green bonds. So now we understand the basic framework of green bonds and where the regulations come to delineate different green bonds or classify certain green bonds, use of proceeds bond, or otherwise. We now need to dive a little bit deeper and we ask ourselves, well, we know what makes a green bond green. Well, what makes a green bond blue? Because, as we know, green bonds are the umbrella term under which blue bonds fit. So in other words, what would a blue initiative or a blue project look like? So, underneath the ICMA principles, which apply to green bonds generally, we look towards a guide or supplement that was released towards the end of last year by ICMA again, where they detail a little bit more non-exhaustive list of the types of initiatives which would be suitable for blue bonds. Some of these suitable blue initiatives are, for example, coastal climate adaptation and resilience, marine ecosystem management, conservation, restoration, marine ecosystems, sustainable blue tourism, sustainable shipping and marine transport. So those are what ICMA would define as satisfactory blue initiatives to class or categorize under the ICMA principles. A blue bond is blue. Again, it's the indicative and non-exhaustive list and is a guide for practitioners, so it's not a closed list by any means. But that's where we would find our guidance towards what is or what is not a blue bond or a blue initiative. So, now we understand, let's talk about a case study of a blue bond. And so our team are currently working on a project in collaboration with our colleagues at the Namibian office. We're advising a Namibian-based sustainable kelp farming business, Kelp Blue, who are seeking to establish a blue bond program. And at the moment it's intended to be listed on the Namibian Stock Exchange. So, first principles, what makes this a green bond? And what type of green bond is it? Is it the use of proceeds? Is it a sustainability linked? So it's a green bond and it is a use of proceeds bond because the funding raised by the issue is intended to be utilized for the planting and maintaining of up to 1,000 hectares of sustainable kelp forest offshore of Blue Ridge in Namibia. So it's a use of proceeds at the moment, it's structured as a use of proceeds bond, so it falls under the category of green bonds, and underneath that it will need to comply with the ICMA principles in relation to a use of proceeds bond. And then on top of that, to make it blue, as we've discussed, it needs to focus on blue initiatives. And so the restoration and fostering of biodiversity, which the issue intends to do off the coast of Blue Ridge, also lends towards the enhancing of marine wildlife abundance. In addition to all of that, the kelp forests and their sustainable farming and maintenance of those forests are expected to play a pivotal role in carbon solution. So there's a bit of green and there's a bit of blue in here. But overall, the intention and where the funds are being directed, the initiative to which are being directed and where the funds are aimed to be flowing are towards blue initiatives. In addition, percentage of the proceeds are at the moment earmarked for helping support the effective implementation of a marine protected area, the management of that marine protected area, which is Africa's second largest reserve marine protected area. So, as we can see, there's detail there on where the fund will flow. And so we know that it's used proceeds bond, and we know that it's a blue bond because the focus there is on blue initiatives. Finally, I'd like to talk a little bit about greenwashing. Now that we've unpacked green bonds as an umbrella term and how they relate to sustainability-linked bonds and proceeds bonds, then we've dived a bit deeper and we've looked at the classification of a blue or a green bond or a yellow bond or pink bond. We've looked at that. sustainable financial instruments without talking about greenwashing. And why is this such an important concept to understand? Is that for financial services providers to be better able to ensure that their clients are protected from greenwashing risks, they need to understand how these risks are mitigated and be able to advise clients on the expected requirements of any sustainable instruments which they would invest in, which they would issue. So what is greenwashing? Well, there's a few definitions. The one I prefer for the green bond space, again, the broad umbrella term, green bond. Greenwashing for me is essentially a misrepresentation about how green the financial instruments really are and how green of an impact they really have, in fact. Is their impact meaningful, or is it just business as usual? And when we talk about greenwashing, business as usual is going to come up with it. So it's important to understand the concept, and of course, in order for the intention of the FSCA's policy to ensure that financial services providers don't sell incorrectly labeled to financial customers, we need to unpack a little bit about what greenwashing is and what it would look like in practice. So, if we're looking at a green bond and we focus our attention to a use of proceeds bond, for example, the misappropriation of funds earmarked for those green projects would be an example of greenwashing. So where funds are not utilized or are not placed towards the green projects for which they were earmarked. That would be an example under a use of proceeds bond. Under a KPI or a sustainability linked bond, where we're looking at the actual impacts of KPIs, an example of greenwashing there would be where the KPIs themselves are not really relevant or core or material to the issuer's business. And again, these KPIs are business as usual. So they're weak or ineffective KPIs that don't drive the issuer to change its business model. One of the most brazen examples of this weak or ineffective KPIs, business as usual, came up a few years back where an offshore bond was issued, which included as a KPI the reduction of indirect or scope 3 emissions, being those emissions which are produced by the issuer's suppliers and customers. So they wanted to reduce scope 3 emissions by 10%. That was the KPI. And they needed to do that by 2030. However, when examining the deal in more detail, it was found that the company, the issuer, had in fact already achieved that key objective before it even sold the bond to investors. Those indirect or scope 3 emissions, as measured, had already fallen by 21% at the time the bond was issued. So there's a brazen example of where a claim is being made and a KPI is being set, but the KPI is being set so low that it's not going to impact the business of the issuer at all. Business as usual. There's nothing that the issuer needs to do to achieve that KPI. So there's some examples of your greenwashing. But how do we mitigate the risks, whether it be potential criminal or civil liability? In the States and the US, there's been a recent interesting move towards criminal liability potentially, and obviously reputational risks that come with these sorts of greenwashing claims. So, to mitigate these, there are a few simple points. I'd say follow the ICMA principles and guidelines as much as possible. And it cannot be stressed enough the importance of transparent, frequent reporting. Finally, when setting KPIs, if the bond uses KPIs, set these KPIs when looking at global standards and taxonomies applicable to the KPIs of the business of the issue as applicable. These KPIs, when set, need to be relevant, core, and material to the issuer's overall business. And again, should not be considered business as usual. So in conclusion, we've discussed green bonds, we've dived a little bit deeper, and we've discussed different types of green bonds. We go a bit further, and we've discussed and explained here blue bonds and how blue bonds rise in the market. And finally, we touched a little bit on mitigation of greenwashing. So thank you all for your attendance and your attention. And again, my sincere apologies for not being able to be there in person. I hope you all enjoy the rest of the day and enjoy the rest of the speakers. The lineup is very good, and there's some really good experts on the panel. So please do enjoy. Thank you so much.
Thanks, Jess. Morning, everyone. I think my job of scaring everyone has been usurped by some of the talks we've heard earlier today, particularly James and the future if we don't take sustainability seriously. I must chat to Martha about tax. We need to have a tax incentive for anti-corruption compliance. I think that's something we should actually think about, because I think that would be quite a useful incentive for companies out there. At the moment, the talk I'm going to give you is all about the new Prevention of Corrupt Activities offence, the failure to prevent corrupt activities offence, which is breaking news. It's brand new, it's a month old. It was signed into law on the 3rd of April by our President. And it has implications for all businesses out there, and it is imperative for everyone just to be aware of what this is all about. And I'm going to walk you through that. If you want to have a look at an article Adrian and I published in the Daily Maverick on this particular topic, it's got a lot of useful information, and that's on both of our LinkedIn sites. You can access it there. What it's all about is it's an amendment to the Prevention and Combating of Corrupt Activities Act, PRECA, and they've inserted a new Section 34A offence. This doesn't impact on 34 per se. 34 is the reporting obligation. Any person in a position of authority who knows, ought reasonably to have known or suspects that an act of fraud, theft, extortion, forgery or uttery or corruption has been committed, that person shall report such knowledge or suspicion to the authorities. That remains. That's important to comply with, because that carries a 10-year jail sentence if you don't report. And we have started getting enforcement in that space as well. What this is about is if a person associated with a member of the private sector or incorporated state-owned entity bribes another person intending to obtain or retain business or an advantage for that member, the member itself commits an offence. And it shouldn't be confused with that Section 34 that I've just explained. There is, however, an important defence, and this is the proactive carrot and stick approach of the NPA. What they have provided is that no offence will be committed where that member had in place adequate procedures designed to prevent persons associated with it from engaging in corrupt practices. And what that means is this has now made anti-corruption compliance a legal requirement for companies out there. So what is important is if you're not sure whether you've got adequate procedures, you need to do a stock take. And the best way to do that is by aligning yourself with one of the compliance principles, and that is to do a risk assessment and just make sure that you've got adequate procedures in place. Why has it been introduced? I'm delighted that some of the recommendations from Judge Zondo are being taken seriously by government. It is important for our country because 2024 is a watershed year for South Africa. Why? We are currently grey listed by the Financial Action Task Force. We're under increased monitoring, and that is set to continue until we demonstrate that we've done enough to address critical weaknesses in our anti-money laundering and anti-corruption infrastructure. And that was identified in the October 21 FATF MER, the mutual evaluation report that was undertaken on our country. At the time, we were only partially compliant with 17 of the 40 FATF recommendations, and we were only fully compliant with 3. In November of 2023, we were re-evaluated by the FATF, and we've done a lot. There's been huge changes and amendments that have come into play. We've introduced beneficial ownership. We've introduced amendments to the NPO legislation, which requires greater declaration of the people behind those NPOs, because these were all vehicles not only used by money launderers, drug dealers, and the like, they were also used by terrorist cells to move funds around. And South Africa was heavily criticized that we're not doing enough to fight terrorist funding. And if we look at our convictions for terrorism in South Africa, we've had one conviction in the last 3 decades. And the FATF have said that is just not consistent with your profile. We know there are terrorist cells operating all over South Africa. We need to do more. And I'm very pleased that we are seeing a spate of new legislation being introduced by government, lots of new initiatives. And last year, I think Judge Zondo threw his toys out the cot and blasted government for not having implemented any of his recommendations. We've seen radical progress since then. Treasury has introduced a progress report that was issued just earlier this year, and I think we've made great progress. But getting back to this new offence, it's quite a scary offence, because what we've done is we've copied what the UK and the US government has been doing for years, and they've used anti-corruption compliance enforcement as a mechanism to extract revenue from wealthy companies that bribe. And this is the pattern that we set to follow. So we've aligned with global best practice. Our offence is literally copied out of the British UK Bribery Act, Section 7 of the United Kingdom Bribery Act, as a commercial offence, which they call the failure by a commercial organisation to prevent corruption. And the term adequate procedures is borrowed from that. The purpose is this will stimulate a lot of companies to settle enforcement actions, and it will lessen the burden on prosecution. And there's more on settling enforcement action, because we've also introduced ADRs, alternative dispute resolution, in the criminal justice process, and I'll talk a little bit about that later. And what it also is designed to do, and I think Judge Zondo was pretty vocal about this, he wants more companies out there to set the tone, to set the example, and to have robust anti-corruption compliance programs. And the more companies out there that have the programs and limit the ability of an organization to pay bribes, the better for the country. There's no offence where the member had in place adequate procedures designed to prevent persons associated with it from giving, agreeing, or offering to give any gratification, prohibited in terms of Chapter 2 of PRECA. And as I mentioned, we've borrowed from the UK legislation, and fortunately the UK are very adept at providing guidelines to their laws. The Americans tried to follow the example. For the UK offence of failing to prevent bribery, they issued a guidance note which is about 10 pages long. The Americans decided, well, whatever the Brits can do, we can do better and bigger. So they produced a 200-page guidance, which is as clear as mud. So reference to the UK Bribery Act is useful because it does set out, I think, very valuable compliance principles. And for years, we've been using the British principles to guide companies on what to do to have adequate procedures. And those principles are very strongly aligned to ISO 37001, which is the ISO standard for anti-bribery management systems. And a few years ago, just when we saw the movement of the anti-bribery compliance requirements, my team and I all became lead accreditors of the ISO standard, and that was useful training. If we look at the UK guidance principles, they basically give us 6 principles that companies need to comply with. And the first one is proportionate procedures. You need to have the policies in place. You need to have the controls. You need to look at the jurisdiction you operate in. South Africa is regarded by the UK and the US as a high corruption risk jurisdiction. So your controls have to be greater than normal. You also look at the sector that you operate in. And that is, I think, critically important. The next item is risk assessment, and that's the principle that I spoke about earlier. If you haven't done one recently, it's useful just to reassess, to benchmark the controls that you have in place and to test the effectiveness of those controls. So doing a risk assessment, best practice is to do this once every 3 years at least. And I think I'm not going to ask the question for hands up, when last did you do a risk assessment? But for many organizations, you'll find it was done in 2013. I think 2001, the PFMA brought in requirements for state entities to do risk assessments, and that's probably the last time many of those entities did risk assessments. The next one is what we call top-level commitment, or tone from the top. And this is how management need to set the tone, and you've got to have evidence of this. So compliance has to be on the board agenda, updates on your compliance programs, updates on training programs, and you've got to make sure that you demonstrate that. So what a lot of CEOs do is they do a little soundbite, a little message to the organization that gets put on the intranet and the internet, and it also goes into training material, and that sets the tone. And for most CEOs, they have a zero tolerance policy to bribery and corruption, and that is important. So having the evidence is going to be important so you can actually demonstrate. I remember a few years ago, I dealt with a South African company. I'm not going to say which industry because I think that might help you to identify the client. But we had a Afrikaans-speaking CFO, and they'd acquired an asset in the UK. And I called him and I said to him, you're going to have to consider complying to the UK Bribery Act, and that's going to mean a change in how you operate. And we need to do a risk assessment and just look at overall in your controls. And he said to me, Stephen, as daai Britse mense vir ons wil kom jaag, ek wys sommer my middelvinger vir hulle. And I had to explain to him, when you sit in with an asset worth a couple of billion in the UK, it's not that easy to just show them the middle finger. And then a couple of months later, they were doing a JV with a US company. And the US company wanted to see their compliance program, and they had no compliance program. And I got a call from the CFO at 11, and he said, Steve, at 1 o'clock, you're going to join a conference call with the Americans, and jy moet sommer vir hulle sê wat jy vir ons gaan doen. And then we explained the whole program, and it was great. I wrote my own mandate, and they were locked into us supporting them for the next 6 months. And within a year, we actually built that program, and it was really great. But that is so important, and tone from the top is important. The next important principle is important for anti-corruption and anti-fraud in any event, and that is due diligence. You have to screen your employees properly and make sure that you only appoint good people and people with qualifications. I think I've done 3 doctorates that are false so far in my career. Sorry, not personally. The due diligence is important on suppliers, and it's got to be risk-based, and you've got to make sure that if you've got agents or business partners, intermediaries that engage with government officials on your behalf, you've got to have the checks and those DD reports, and then you've also got to have the anti-corruption clauses in your contracts, and make sure that you explain your process, share your code of ethics, code of conduct with them, and make sure that you bind them to behaving in accordance with your ethics. And then the next one is communication, and that is embedding your anti-corruption, anti-bribery processes and policies throughout the organization, making sure that you train your people. And best practice for anti-corruption is to do annual training. So that is quite important as well. And then the last principle in terms of the UK is monitoring and review. And in terms of monitoring, Adrian, I'm just going to forewarn you, you're going to do the ADR section. So I'll hand over to you in a moment. I thought I wouldn't just drop him at the last minute because I said I'll do all the talking today. The last principle is you've got to demonstrate that you are re-evaluating and monitoring and checking the effectiveness of your anti-corruption program. And usually it's important to do some transaction testing, check for declarations of conflicts of interest, declarations of gifts, entertainment, making sure that your gifting is modest, etc. I've put in the CIPC guidelines, and I'm not going to go through each of those, but you can see that they're very similar. So top management commitment, clear practical policies and procedures, and the policies are all around gifts, travel, entertainment, due diligence, sponsorships, etc. And then auditing and accounting controls is introduced. The auditing is a requirement of the UK legislation, but it's a separate principle in terms of the CIPC guideline. And the CIPC guidance note was issued in November 2018, so it wasn't specifically for the program, but it does say, these are what a good anti-corruption compliance program should entail. And then communication and training, periodic reviews is the same as the monitoring. So Adrian, I'm going to hand over to you, if you don't mind. Sorry, I didn't forewarn him, so it's a good test of his adaptability. Thanks, Ed.
Thanks, Stephen. I like that you say you're not going to drop me in it, but a minute's warning is sufficient.
Come on.
So I think just before I jump into the new CADR, or Corporate Alternative Dispute Resolution Directive, that the NPA in South Africa has just published, I think it's very useful just to quickly provide an overview of the deferred prosecution regime in the US and the UK. So if you're not familiar with these, it's a non-prosecutorial outcome that the prosecution uses effectively to short-circuit the prosecution process. So a criminal trial, especially with large organizations and complex corruption and fraud, etc., can be lengthy, costly, and there's no guaranteed outcome at the end. So that's the prosecution's incentive to try and enter into a quicker resolution, effectively a form of settlement agreement. Then the company on the other side that's facing corruption charges obviously has a huge reputational risk. There might be pressure from shareholders. They want to wrap this up as quickly as possible, and they want to agree on a definite financial penalty at the end of it. So what these DPA regimes have been used for very successfully in the UK and the US is to enter into effectively settlement agreements where the company avoids prosecution, but the prosecutor will ensure that they disgorge the profits, that they'll impose a financial penalty, and there'll be certain other requirements that the company will have to comply with for a set period. Sometimes a compliance monitor is dropped into the organization to check that their anti-corruption procedures are up to scratch and to make sure that they don't re-offend. There's been huge settlements that the US in particular have been able to arrive at using these DPA mechanisms. I'm talking billions and billions of dollars. So it's not like the company's getting off scot-free. The opposite, it's hugely costly, but I think it's a best case outcome where everyone wins effectively, because as I said, you've short-circuited a long and costly trial, you've disgorged the ill-gotten gains, and also the company has avoided getting a criminal record, which can obviously lead to disbarment and can be hugely costly for the organization as well. So what we've done historically in South Africa, there's two, I won't name the companies implicated, but there have been two very high-profile settlements in the last 2 years where effectively the South African companies have worked, the NPA has worked in conjunction with the US DOJ to investigate instances of corruption and arrive at a settlement locally. The issue with that is the settlement agreement is secret. We find out about the quantum that the company had to pay, but we don't know what happened. We don't have the full facts. So we're missing some of that key detail, which I think the general public has a right to get. So my criticism up to this point, was we need to mirror the DPA regime in the US and the UK. We need to move to a more structured place. We need to know, let's say I'm a legal advisor to a company, I need to know what are the principles that are going to determine whether a particular company will be eligible to arrive at a non-prosecutorial outcome. So obviously very welcome then when the NPA published the Corporate Alternative Dispute Resolution Directive, which gave us exactly that. It's very similar to the DPA regime in that there are clear principles that determine when a company might be eligible. These include things like cooperation with the prosecution, agreement to pay back ill-gotten gains, and also there's a key requirement for publicity, which is critical. So the actual outcome must then be published on the NPA's website. So very welcomed introduction into our space, and goes hand in hand with this new failure to prevent offence, because at the same time as we've introduced the stick, there's also a possible out for organisations that admit to, look, we've identified corruption within our space, we know we have to pay back the ill-gotten gains, but we obviously don't want to be convicted of corruption, so let's arrive at an agreed outcome. But yeah, that was a quick overview. Stephen, do you want to just conclude?
Thank you.
Thank you, everyone.
Okay, I'll remember that for your performance evaluation. So these are the principles Adrian has highlighted, and I did the cleanup of EOH, and we used to joke about EOH, and we used to call it EOH at a period during the investigation, because we found huge corruption in the organization. They brought in a new CEO to do the cleanup, and Stephen van Coller, you've all read, he recently exited EOH, and I think he'd done the job that he'd set out to do by cleaning up. We ended up self-reporting at least 14 different matters to the DPCI, and we worked closely with the DPCI, we worked with the SIU, the Asset Forfeiture Unit, and we had to engage in discussions with the Competition Commission, the BEE regulator, because there were all of these different offences committed along the road. And all of that was done informally, and you had to negotiate with each different regulator, and it was challenging. And as you overcome one hurdle, you'd have the next one. With the ADR guidance that's been issued by the NPA, companies that identify wrongdoing within their own organization will now have the ability to approach the NPA directly and do an arrangement which will avoid a prosecution. Adrian highlighted how important it is for a deferred prosecution agreement to a corporate. Can you just imagine if a large blue chip South African company is prosecuted, what happens to the share price? EOH went from 170 Rand a share, and at their lowest point they were trading at 5 Rand a share. And I think the current value is around 15 Rand a share. That's a huge amount of shareholder value that's just eroded completely. If the company is convicted, they will automatically be debarred from doing business with government. And that was one of the big missions. Stephen and I went to go see the DG at Treasury to try and persuade them not to blacklist, because when you admit to corruption, any entity, any government department that has been the victim of the corrupt activity can apply to Treasury to have the entity blacklisted. And if a large part of your audit book is dependent on government, it's going to wipe out that business. So we persuaded the DG not to blacklist, and we showed him that we were doing all the right things. And without being forced to do so, they built an anti-corruption program where there was nothing previously. They built a team of anti-corruption compliance people and appointed heads of compliance. Even internal audit didn't exist in the old EOH. So we could show that we had implemented governance. And this was important because what happens with clients, good corporate citizens, the banks, the financiers, the customers, they all want to do business with ethical companies. So once you identify corruption in the organization, many of those entities want to blacklist. And we had to persuade a lot of large corporates to lift blacklisting that they had put in place. And EOH was in a group that included Bain and Company, McKinsey and Co, and an audit firm, KPMG at the time, was going through a torrid time with all the different scandals. And we had to show and demonstrate through these 6 principles that we've spoken about that the company has done enough to prevent corruption and that you can continue to do business with this business partner. It was also important to do the same with the financiers, because the banks wanted to pull the plug on further funding to the organization. And we I went to meetings with Stephen van Coller where we showed the banks what we were doing. We showed them we were transparent with what we had identified and what we were doing to fix. And that recipe was an informal recipe which has now been formalized with the ADR type of program. And just to give you a feel for the types of penalties, Adrian spoke about billions. Airbus did a settlement with the UK government, the Serious Fraud Office, the prosecutor in Paris, the French Prosecution Office, as well as the DOJ and the SEC in the United States. It was a collaborative effort. The collective penalty on Airbus for bribes in Africa, Asia, Latin America was $4 billion US. Siemens held the record for decades, for more than a decade, for the highest fine, and they paid $800,000 US to settle an enforcement action in 2010. And every year, the US government makes approximately $2 to $2.5 billion out of settling enforcement actions. So this is the big opportunity that I think the revenue authorities have seen to make money out of corruption by making examples of companies. And by making examples of companies, they will also send a strong deterrent message to would-be offenders. The last development we're going to touch on is just some proposed reforms to the whistleblower protection laws. In August of last year, commentary closed on a white paper that was released by the Department of Justice proposing extensive changes to whistleblower protection in the country. And you'll remember Judge Zondo has also emphasized how important it is that we protect whistleblowers and encourage them to come forward when they identify corruption within organizations, and how we need to better protect whistleblowers. So some of the proposed amendments are the expansion of protections beyond employees, because at the moment, security guards, domestic cleaners, and labor broker staff don't qualify for protection because they're not employees. We're also introducing confidentiality obligations so that we protect the anonymity of whistleblowers where it's necessary. And then this one is quite scary. There's a reverse onus, creating a presumption of retaliatory action against whistleblowers, and it removes the burden for the whistleblower. So the onus is going to be on the employer to disprove the whistleblower's allegations. I think that's a bit harsh, and I hope that that doesn't get through in the final version. Why do I say that? Because I've done a number of investigations recently where we've dealt with, I don't know if I can call them malicious whistleblowers, but whistleblowers with dubious motives, I think is probably the best way to describe it. And they are obviously not protected. And the companies that I've acted for, they often grapple with the situation, what do we do when someone has blown the whistle maliciously? It's cost us a fortune in terms of damage to reputation, costs us a fortune to have us investigate, and you never really recover from that. What do we do? And my advice to clients is don't pursue the whistleblower. It's not a very productive exercise, and you don't want to send a negative message to other bona fide whistleblowers. So often these bad whistleblowers get a soft landing because of those types of factors. But we are going to see some more debate around this. There's also been some debate around whether we incentivize whistleblowers. And just to give you a feel for what the US Department of Justice does, remember I spoke about how they make more than $2 billion a year out of penalizing or entering into settlements with companies that bribe. They advertise incentives to whistleblowers. And in terms of the Dodd-Frank legal reforms, which came about just after the Bernie Madoff scandal, the US government decided to incentivize whistleblowers between 10 and 30% of whatever is recovered from a company in an enforcement action is the potential incentive to whistleblowers. And the highest reward paid to date, $30 million to a single individual. I'm very upset with the limitation they put into the legislation. They said lawyers are not eligible for the reward. So the last thing that I wanted to highlight was They want to include a procedure for anonymous disclosures, include whistleblowers in the definition of witness in the Witness Protection Act. And then lastly, they want to create a fund for whistleblowers that experience financial hardship. And you've seen the horrible plights of whistleblowers, particularly in government entities in South Africa, where they've lost their jobs, they can't find new work, and they really struggle. So some of it is positive, some of it is quite, I think, risky, but lots of change in the governance space. So I think I've timed it to perfection, which is not usually my style. But thank you, Jess. I think we're about to break for some tea and refreshments.
Even those of you who were, you didn't have to stick around. So this is going to be a bit different to everything that you've heard so far. As Jess mentioned, this is about human capital. How do you keep the humans in your employ, on the one hand, happy, and how do you keep them in line, and what does that mean for ESG purposes? I think it's important before AI-powered robots take over. One of the places they're going to take over is the workplace. Before they do that completely, I think we need to look critically at these issues. I think lots of employers are looking critically at these issues, and through the lens of ESG, certain of the topics are particularly important. I've tried to highlight just a few of them that are particularly close to my heart and squeeze it into sort of 20 minutes and 10 slides, maybe optimistic, but let's see how far we can get. So 3 broad topics I'm trying to cover today, starting with diversity and inclusion at the workplace. What does that actually mean? Then looking at some remuneration and benefits policies, attracting and retaining talent. And then some of the less glamorous stuff from a compliance reporting angle, looking at the employment equity reporting landscape and a few interesting changes that are happening there. When it comes to diversion and inclusion, inclusivity in the workplace, these types of words historically would have just been words. You'd have somewhere a corporate mission statement somewhere on your website, if you could find it, which says, look, only do good things, never do bad things. We like making our employees happy. We plant trees sometimes. It's all fantastic. And that would be great, and that would be sufficient. But nowadays, we know that's no longer sufficient. These issues are being properly scrutinized. They're being accorded a financial value. We're seeing a number of clients come to us engaged in some kind of transaction, whether it's an investor wanting to know whether they must invest in a business, whether it's a purchaser wanting to purchase a business. They want to know more than you have 1,000 employees, they work in a factory, they make lots of widgets, widgets are good, we sell the widgets, we make money. They want to know much more than that. They want to know about the humans that make these widgets and what is happening with these humans. Are they happy humans? Are they sad humans? Are they striking? What are they doing? But not in a kind of tick the box exercise approach, in a proper approach, because they're going to be taken to task about these issues, whether that's at board level, as I mentioned, funding, investor level. Someone's actually going to ask them proper questions about these things. So they come to us nice lawyers and they say, here, look at this company and tell us these things. Yes, we know about compliance with the Labour Relations Act and the BCA and all that fantastic stuff. We can probably do some of that ourselves. But look at these other issues. Historically, the softer issues, which are now getting a lot harder and have a lot more teeth to them. So here I just grabbed from a particular policy which I found on the internet some of these words, which, as I say, historically would have been close to meaningless and found everywhere, but that you're finding more and more. We took this from a human rights policy, and we're going to mention human rights policies in a bit more detail just now. But you'll see the things here, and I'll touch on a few of them. It says, in terms of kind of a mission statement for this company, we value and advance the diversity and inclusion of the people with whom we work. We're committed to equal opportunity and are intolerant of discrimination and harassment. We work to maintain workplaces that are free from discrimination or harassment based on race, sex, color, national or social origin, ethnicity, religion, age, disability, sexual orientation, gender identification or expression, political opinion, or any other status protected by applicable law. We do not tolerate disrespectful or inappropriate behavior unfair treatment, or retaliation of any kind. Harassment is not tolerated in the workplace and in any work-related circumstance outside the workplace. And in South Africa, it's quite interesting because some of these things are specifically regulated and well regulated. The employees have a lot of protections, and the people with whom employees interact also have statutory protections. But that's not to say that there isn't a renewed impetus on regulating these things where you don't have to. Where you don't have to have a human rights policy, for example. If you asked me 5 years ago to draft you a human rights policy for your company, I probably wouldn't have known where to start. But now we're getting these queries from clients kind of on a weekly basis. Can you look at our existing human rights policy? It's not very good. It's from the 90s. Can you draft us a human rights policy? And there's no legislation that says you must have a human rights policy. There's nothing to say what must go in it. But it's still a necessary thing that you certainly should be considering if you're an employer in South Africa in 2024. So what goes into a human rights policy? And it's a sort of blue sky area of the law, which is always fun for boring employment lawyers, where we have to do a bit of thinking out of the box, good in the box, not always good outside the box. There is a lot of guidance on what goes in a good human rights policy. And where do we get it? We get it from existing human rights policies that employers have around the world. So we've listed here a few of the key elements. It's not meant to be a closed list. It's just you see these things repeated across different human rights policies, across different employers throughout the world, not just in South Africa. So you have their typical reference to international standards of human rights. In the South African context, you might reference the Constitution and the Bill of Rights and the fundamental rights that are established there. Workers' rights provisions, of course, critical for this type of presentation. Then if your particular sector has specific human rights that are of particular relevance, maybe you're in mining and it's to do with, where does the lithium that powers all of our lovely batteries that we're running these sustainable, solar installations that we all have at home and we're very proud of. Where did that lithium come from? It came from some mine. Okay, how did we get it out? There was some human mined it out of there. Okay, tell me more. These questions which historically I think would have just been footnotes, and yes, it's coming from somewhere, but just give me the phone, give me the thing, I need the thing. The sweatshop, no, never mind, shh, don't worry about the sweatshop. Now we want to know, and investors want to know. And it comes up at board meetings and it's items on agendas. You can't just brush this stuff under the carpet. And for employers, you've got to write it down in your policies so that it's not sufficient to assume that people are going to always do good things and never do bad things. Put it down, write it down. And the last point there, implementation of the policy. This isn't something that you can bury on your intranet, some portal that no one's ever going to access. Historically, it would have been a dusty archive room that no one ever goes into. If you have this policy, make your employees aware of the policy, what it means, what they should be doing, what they shouldn't be doing, and hold them accountable when they don't do the things that you say they should be doing. Of course, it goes without saying that the negative consequences of human rights violations are significant in every respect. But I think what has changed is what I've already alluded to, that historically, the kind of reputational damage that might be wrought upon a company with some questionable human rights issues may be less than today. Today, it's easier to root out those issues. It's easier to find out about them. It's easier to publicize them immediately. And for the effect, as we heard from Stephen's presentation, on things like share price, to be immediately reflected and sometimes irreversible, regardless of whether it's true in some circumstances. So the more mechanisms you have in place and the stronger and more robust your framework is in your workplace, where you have a workforce that knows, don't do these bad things, only do these good things. And this is why, the better position you're in as an employer. One thing that's increased, unfortunately, particularly in South Africa over the past, I'd say 5 years perhaps, people have found new and more inventive ways of harassing each other. So this is one area that the law had previously recognized. And of course, the Employment Equity Act has strong provisions against harassment. It's one of the very foundational things for which the Employment Equity Act stands. There was a code of good practice on the prevention of sexual harassment in the workplace previously, which came out in 2005 and dealt in detail with what is sexual harassment, what should you do, what shouldn't you do, what happens if it does happen, what must an employer do, both to proactively prevent sexual harassment and root it out once it's been discovered. And that was good and sufficient for sexual harassment, but it didn't deal with other forms of harassment. And we'll all know and be familiar with things like online intimidation in this era of everybody's on their smartphones and being harassed by various things, good and bad. Things like bullying, intimidation, those kinds of things. Things like an eye roll can be harassment if deployed appropriately. And you can imagine where the parties don't stand on an equal footing. If you're going to your boss with great suggestions and he's always rolling his eyes at you, or sending you WhatsApps late at night saying, you're such a loser. That's not a great place to be, and it's something that the law has recognized. And they've published this fairly forward-thinking code of good practice, which is a bit of an unfortunate term, but it's preventing different forms of harassment and things like psychological abuse, which historically wasn't recognized at all. It was easy enough for a labor court judge to say, hey, you went and you smacked your manager in the face. That's not good. You probably should have been dismissed. But psychological forms of harassment can be just as damaging. And the law now recognizes that with this specific piece of legislation. So that's really great. And it's something that employers need to bear in mind when preparing their own policies, because we get a lot of requests from clients. They come to us and say, here, look at all our policies. Aren't they fantastic? Here's our sexual harassment policy. It says don't do sexual harassment. It's bad. If you do it, this is what's going to happen to you. And we say, yes, that's fantastic. Have you heard of this new code of good practice on other types of harassment? They say, no. Okay, well, maybe you should put that in to your policies. They say, okay, yes. What if we don't? We write their harassment policies are mandatory. They're not strictly speaking mandatory. There's no piece of legislation that says you must have an anti-harassment policy, otherwise you're in breach of this act. But the way the act does it is kind of backwards, with an interesting vicarious liability provision in the Employment Equity Act. When it comes to harassment and sexual harassment, it says that you, as the employer, are vicariously liable for the conduct of the harasser if certain things. And the if is important. It's if you, as the employer, haven't taken reasonable steps to root out the harassment once you've discovered it, but also proactive steps to prevent the harassment from occurring in the first place. And these proactive steps, the courts have said, are typically in the form of having a policy, explaining to employees to the extent that you need to, that you shouldn't do some of these bad things. And these are the consequences if you do the bad things. And training employees. Don't just have the policy and stick it on your intranet, have someone tick a box on an email to say, have you read the policy? Yes, of course, I have read the terms and conditions. Yes, give me that iPhone update or whatever it is. Yes, fantastic. Train the people. Bring them into a room. Poke and prod them gently with words. Get them to understand what they must be and mustn't be doing. And these kinds of things, when you're assessed, the Department of Labor comes around from time to time and says, show me your compliance with all of these acts. These are the things that they ask for. They want more than just lip service being paid to all of these important rules. Now for something a bit happier. That was all a bit bad news, doom and gloom. So the second part of the talk is about when we're looking at things, we're looking now at the S of ESG, the kind of social element. And we're talking here about equitable and progressive remuneration and benefits policies. So we're talking about attracting and retaining talent. And what kinds of things are we seeing from clients and in the industry when it comes to these recruitment type issues? And we'll all be familiar with some of them, but they bear repeating because they keep coming up over and over again. Starting with things like flexi time. So this, importantly, is when you do your work, not if you do your work or where from you do your work. So is it fine if you work from 10 to 3 and outside those hours you have other commitments? It doesn't matter what those commitments are. It might be family commitments. You need to take little ones to school because they can't drive yet and they're useless. It might be you want to go to the gym. You want to lie in bed. You want to do whatever. There's an increasing recognition that that might be all right. People might be allowed to be people when they're not being your employees. And more than just a recognition, we're all aware of new entrants to the market are demanding this, demanding at least a discussion of this. No, I'm not going to work for you from 7 a.m. to 7 p.m. That doesn't work for me. I'm rather not going to work for you then. Tell me about your flexi time policy. Oh, you don't have one. Okay, that's interesting. I can go around the corner, there's this other company. They have a policy. It's not work whenever you want and, I'm the boss of you. It's not that at all. You must do your work. You must make your widgets. But I don't care whether you make your widgets from 10 to 3 or from 5 in the morning until 5 in the afternoon. Make the widgets. I'll sell the widgets. We're all happy. So it's things like this. We're increasingly getting asked to prepare flexi time policies. And a lot of thought has to go into it because you have to look at each business. Each business is different. It's not going to work for everybody. And how it works is going to vary. But it's something that you have to consider. Then remote work is, of course, where are you when you're doing this work? If you're making widgets in a factory, you might have to be in the factory to make the widgets. All the other people in this fantastic widget factory, they might not need to be there. If you're not standing on a widget making machine churning out widgets, you might not need to be in the factory. You might not need to be there all the time. You might be able to work remotely. We all did it during COVID lockdown. Some industries discovered, hey, we work well remotely. But we all know that came with consequences as well. It's difficult for most companies to survive working fully remotely, 100% remotely, where you never get together in a room and can come and wave at your colleagues and actually see them face to face. Some industries are better at it than others. Law, surprisingly, we did quite well. We all got our computers up and running, got our fiber installed, and we had meetings via Zoom to begin with, and then Teams, whatever it was. And I'm sure we all do the same nowadays. But of course, there's been a gradual dragging back to the office of a lot of employees, and some kicking and screaming because they've already developed their lives around, no, I'm not commuting for 2 hours into the office to sit and have a Zoom call with someone else. I can have the Zoom call from home or from top of Table Mountain or from Barbados and do it from wherever. And these are things that have to be considered and critically analyzed. And again, it's things that new entrants to the market are demanding. So you have an office and I must be there 100% of the time. Okay, that's really interesting. And I must work 7 to 7. That 10, 15 years ago, that might have been the accepted norm. But we're seeing increasingly that not being the case. I've got a survey here. Surveys are great because they say whatever you want them to say, but we found a survey that said, and a recent one from South Africa, 52.3% of respondents to the survey would leave their jobs if they were forced to return to the office. So this is obviously people who aren't currently in the office. And I'm sure we've all dealt with this kind of push and pull, accepting that some parts of some jobs you need to do collaboratively, and collaborative work involves coming together, sitting in a room and hashing the thing out. And hopefully focusing on the thing that you do. Not wasting as much time talking nonsense around the water fountain or wherever you talk your nonsense, but engaging constructively on things, wasting less time, being more profitable for the business at the end of the day. Then, just on these types of models and where we work, the most popular model appears to be hybrid. So 49.6% of the people surveyed by this survey, I'm going to tell you any more about who it was, 3 people I found on the street, but 49.6% of them work a hybrid model. So not fully at home, but not fully in the office. And there are the office-based and remote statistics for you as a comparison as well. Purely office-based, as low as 9.6% who are always in office. And we're talking about corporate employees here, not widget makers in a widget factory. And these numbers are changing with time, but I think it's things with which we've all had to grapple. And these are kind of the ideas that you have to think about when you're talking about attracting and retaining talent. Then just quickly on leave entitlements and remuneration. Granting your employees leave is a good start. That is a statutory minimum requirement. You must give them some leave. The idea being you work hard for your employer and then you're knackered and you need a break. Then you can come back and work hard again and you earn another break. That's fine. I think we're all happy with that. And we must pay you while you're resting on the basis that you're going to come back and then earn us more money. It's fantastic. The minimum leave entitlements in South Africa are not very favorable. They're more favorable than some other jurisdictions. But we're seeing increasingly more favorable policies being put into place by medium-sized to large corporates that are much more favorable than the statutory minimums. When it comes to annual leave, some companies even have this notion of take as much leave as you like, and subject to lawyers having a go at the policy and saying subject to this, and here's a footnote, and there's a soft cap of 60 and a hard cap of 100, but take as much leave as you like, and then we'll see how that goes. And it's working for some employers. Some employers are embracing that kind of idea. Then things like family responsibility type leave. The position in South Africa, again, is kind of middle ground. We're not as good as some countries, Scandinavia. We're not as bad as some of the countries in the United Arab Emirates, for example, in terms of maternity and paternity leave. But there's definitely a shift towards being better and towards also being more equitable, granting both parents in a family relationship at least an entitlement to the same amounts of leave. How you split up that leave is up to you. And there's a High Court decision which found some parts of the current leave provisions in the Act unconstitutional. That's now got to go through the constitutional process of, will the Constitutional Court agree? What will they do? But again, however that court rules, we're seeing policies far more beneficial than however that case is going to land. And then just a couple of more issues on remuneration in general. We just highlighted some issues there for consideration. Equal pay for work of equal value. Share incentive schemes, we're seeing a lot of work around that to incentivize employees to do good things by giving them a piece of the business that they're doing the good things for, rather than just some cash. And bonuses and things based on company performance, not just individual performance. So an idea of kind of Ubuntu, it's not just I, it's we. We work together to get to this outcome. So if the company benefits, you benefit. Then the boring part, I should have put this at the start here. I shouldn't have ended with the boring parts, but it's fine. And it's not boring if you're an employment lawyer, and maybe some of you are all excited by employment equity reporting. So the takeaway message from this, currently, if you're a designated employer, you must report on employment equity. Employment equity being how your workforce is comprised in terms of demographics of people. So black, white, colored, Indian, male, female, people with disabilities, those kind of demographics. The idea being we want workplaces in South Africa to look like the rest of South Africa in terms of those demographics. The important takeaway is that if you are a designated employer, you must do this annual reporting, and it's quite an onerous process, and it's difficult to do the reporting. It's also difficult to comply with the targets. At the moment, there's this 50 employee threshold. There's also a turnover threshold which applies, and you only need to meet one of the two requirements in order to have to report. So you either have to have 50 employees or have turnover of, for the purposes of the finance and business services sector, 30 million rand per annum. And that's turnover, not profit. Then you have to do this reporting. Now, there are amendments in the pipeline which are going to remove the turnover thresholds, and you'll only have the 50 employee threshold. They are still in the pipeline. We're awaiting a date for them to actually become law. Similarly, sectoral numerical targets, you might have heard something about that. It was a big topic for us employment lawyers. We were very excited about it. That is also in the pipeline. So how you do your employment equity reporting and whether you can rely on being in a specific sector which has its own specific demographics of people, rather than just being in the Western Cape or being in South Africa and relying on the demographics of the whole country. That's something that's also receiving a lot of attention and soon will hopefully come to pass. I like to sort of end my talks on a kind of note. I think I've done that. So thank you for your attention.
Good morning, everyone. So it's not every day we hear about a company bringing legal action against its own shareholders. These are the supporters of the company, the owners of the company, primarily funders of the company. So when this happens, we find ourselves asking, what went wrong? There's a lot that I need to say in a nutshell, and I'll try to keep it to 10 minutes. The case concerns a proposal to add to the agenda, the AGM agenda of Exxon, a climate action matter. And how the proponents wanted to do so is through the proxy process. So what this enables shareholders to do is to attend and participate at a meeting that they can't attend. Many years ago, somebody painted a picture, people got in their horse and carriage and they went to the shareholders meeting, and then the shareholders, the companies became so big that shareholders could no longer attend shareholders meetings, and they appointed proxies. We've probably come sort of full swing to electronic participation these days, and more shareholders can participate, but the general practice is with the large companies, shareholders appoint a proxy to attend in their stead. What happened in the Exxon case is that these proxies, who have their own businesses, enterprises, their own objectives. Their purpose is to pursue ESG-related initiatives, one as an impact investment house and the other as an NGO. They garnered support from the Exxon shareholders to put forward an item that was close to their hearts. However noble it was, the question that this raises is this a valid use of the proxy process? It's a governance process to enable shareholders to be present when otherwise not. And Exxon roundly rejected the proposal, citing a number of deficiencies, and then went to court a few weeks later to ask the court to confirm that the shareholders, activists anyway, don't have the right to use this proxy process to put forward what Exxon believes to be their personal agenda items. And so Exxon has pushed forward with the lawsuit nonetheless, because it is looking for confirmation from the court as to whether this is a valid use of the corporate governance processes and principles within the organization and the US securities laws. And because it's pushing ahead, notwithstanding that the proposal has been taken off the table since by the shareholder activists, it's no longer being put forward. There are now murmurs in the market pushing shareholders at the AGM next week, so it's happening on Wednesday next week, to not vote into power or re-elect the chairman, the chief executive, the lead independent director, because these are things that the shareholders are going to be called upon to do next week. So as this battle unfolds, we ask ourselves, in South Africa, could a similar scenario play out? And if it does play out here, what are the rights on either side of this battle? Now, under South African company law, any two shareholders, regardless of the percentage shareholding that they have in a company, are able to put forward resolutions for the shareholders to vote on. And those resolutions just need to be sufficiently clear, supported with the necessary information to allow shareholders to decide whether or not to vote on a matter. And also they need to relate to matters that the shareholders are entitled to vote on. So the question this raises for us is then, in South Africa, what are shareholders entitled to vote on? Now, the starting point is that in terms of our company's law and across many jurisdictions, the board has the authority to manage the affairs of the company. So our Companies Act provides that the board has the authority to exercise all of the powers and all of the functions of a company. So the board needs to be properly constituted with the necessary experience, expertise, and skills. And each member of the board then has a fiduciary duty. These are things that the shareholders don't have. The Companies Act does, however, carve out for the shareholders matters in respect of which they are required to resolve or to determine. So those are shareholder resolution matters. Those are clearly set out in the Act. What the Act doesn't do is it doesn't expressly provide the shareholders with the right to act beyond those listed powers. It doesn't say outside of these shareholders' resolutions you can also adopt other resolutions. So the question is then, on what basis could they bring forward matters that are not within their remit? Particularly because the starting point is the general position that these are board functions. Everything else is a board function. Now, we also have proxy rights under South African law. The shareholder can't attend, can appoint a proxy.
But in the US, it's a little bit different, as we see through the Exxon case, where in terms of US securities laws, the Securities and Exchange Commission, or SEC, has additional rights to interfere almost in the proxy process. So where you have shareholders that are unable to attend and decide to participate through the proxy process, there's an additional sort of process that needs to be followed under US securities laws. And in terms of that, there's a list of about 13 issues, which are exclusions or exceptions that enable a board to exclude matters from the shareholders' meeting. So if through the proxy process, people are trying to table matters before the general meeting, the board can exclude those based on these exceptions. One of those is being relied on by Exxon, and that's the ordinary business exclusion. And the SEC has issued guidance as to what this means. And they say that the resolution of ordinary business problems should remain with management. It is impractical for these issues to be sought to be resolved by shareholders at an AGM type process. So, bringing this closer to home, a few years ago, we had a crowd called Just Share. I don't know if you've heard of them. They and some other shareholders sought to also table, similar to the Exxon, climate risk-related resolutions at the general meetings of Exxaro and Thungela. Both of these companies rejected and refused to table the resolutions, much like Exxon. And they cited again, similarly, that these issues are within the prerogative of the board. These are day-to-day business issues. Just Share cautioned in their response, beware directors at the upcoming meeting because the shareholders have to re-elect you. So the Exxon sort of circumstances are not too unfamiliar to us in South Africa. And it's not to say that these climate risk-related proposals never see the light of day, never make it through. There's of course a difference, and Jess pointed out earlier. There are the resolutions, binding resolutions, then there are these advisory matters that can be put forward, and then there are also just issues that the shareholders can raise on the day at a meeting as well. But looking at the shareholder resolution position, we have also seen about 5 years ago at a LISCO AGM, shareholders successfully proposed climate risk-related resolutions. They were tabled at the Standard Bank AGM. There were 2 resolutions proposed, one to introduce reporting requirements and the other policies to be disclosed. The first one was rejected by the shareholders, the second one was approved. And so it went through, was adopted. And this was through the shareholder proposal process. The same crowd, Just Share, very active in South Africa, to be watched out for. They also sought council's opinion, in fact, just a few years ago, as to whether it is competent for shareholders to bring these climate risk-related proposals to a company to be tabled at the general meeting. What I call the spirit and purport approach is what council has adopted. So they looked at, and that's a senior counsel, so an advocate's opinion, they looked at the purpose of the Companies Act. And that's the only thing that they could look at, I suppose, because there is no clear right. And looking at the purpose of the Act, which refers to the Bill of Rights, constitutional imperatives around environmental issues and social issues, they concluded that the board does not have the right to reject these proposals that are being put forward by the shareholders. So Just Share now has increased bravado to support its cause. It also maintains that there's also support for the courts likely finding in favor of the shareholders if this were to go to court. What council has proposed is that if the board is not in favor of tabling these resolutions, it should either go to the shareholders and ask them to consider the matter, or it should go to a court and ask the court for a declarator, much like Exxon has done. So these are just views. It has been untested as yet through our courts. And where does that leave us then? Well, shareholder activists may now have more confidence to push matters through the AGM because there's a council's opinion that's been obtained. There is still this uncertainty, though, as to whether it is at all competent for them to raise matters that are not within their remit in terms of the Companies Act. Exxon has sent a clear message to the market to say that the board function will be guarded as a governance imperative. And so that might give corporate more confidence to bat away these proposals to the extent that they are harmful to the company. Right? Let's bear that in mind. In this case, these companies have ESG on the agenda. What happened in the Exxon case is they were seeking to accelerate, the pace of change. And so there's also uncertainty in that regard because there's no clear right for the board to make this determination either in terms of the Companies Act. Ultimately, the shareholders are the owners of the company. They have the right but also a duty to appoint the directors. The directors have fiduciary duties to act in the best interest of the company. And they can be held personally liable for failing to maintain their duties. And so, as one commentator says, because we have specific matters in the Act that are within the ambit of the shareholder approval regime, perhaps it's best for the shareholders not to second guess the directors on the other issues, to make sure that the board is properly constituted and then hold the board to account. So going back into the Exxon case, and what does it hold for us? What impacts are there? What can we learn from it all? We know, and it makes us stop and think, that shareholder activism has undoubtedly had a profoundly positive impact on ensuring that companies pay more attention to sustainability issues. From introducing investment policies, reporting policies and guidelines, disclosure. We know that one of our clients, a large asset manager, has said the imperative is not risk and reward, it's risk and reward and impact now. That's what they've got to look at. But there is the potential for abuse. And that's what the tension, I suppose, where the tension exists. And it's where this proxy process could potentially be hijacked to solely drive a personal agenda at the expense of rights and interests of the general body of shareholders. So we are in untested territory. We have the Exxon case, it's still ongoing. The AGM is next Wednesday. We'll be voting for a new president. They might be voting for a new president of the company. But it has the potential to set a precedent on both the side of the ESG activist and the company, South African companies as well, as to how they then position themselves on these issues around sustainability and governance going forward. Thank you.
Good day, everyone. I prepared like a joke that would only work if I'm the last speaker, so I'm not going to go with that joke. As Jessica has already said, my name is Refilo Mpero. I am in the Dispute Resolution Department, which is also known as the Litigation Department here at ENS. This afternoon, I'll be speaking to you all about legislative and regulatory developments which encourage businesses to operate sustainably. So I'm going to discuss some important regulations, in fact legislation, some case law, and some other documents that are important to this subject. So the first legislation I wish to discuss is the Companies Amendment Bill of 2023, which is bringing about change regarding the appointment, the composition and reporting of the Social and Ethics Committee in a company. We know that the Social and Ethics Committee was introduced in our law by the Companies Act of 2008, and it is a committee which is concerned with a company's responsibility in areas dealing with social, commercial, and environmental matters. So under the Companies Amendment Bill of 2023, this bill, by the way, would be signed by the President, I'm sure, sooner rather than later. Under this bill, the Social and Ethics Committee must comprise of at least 3 members, and those members must be non-executive directors in the case of public and state-owned companies. And they must prepare and present a Social and Ethics Committee report to shareholders at the AGM every year. Now, having looked at the Companies Amendment Bill of 2023, which is still coming into operation, we can take a step back also to look at the Companies Act of 2008, which has set the bar very high in that Directors and officers are expected to act in good faith in the best interest of the company and with a degree of care, skill, and diligence that would reasonably be expected. The Companies Act of 2008 also promotes transparency and accountability without explicitly stating ESG practices. But directors must always keep the provisions of the Companies Act of 2008 in mind when using their discretion in relation to ESG matters, and always, of course, consider the broader impact of the company's activities, including environmental and social factors. The global challenges ranging from poor working conditions, climate change, and the violation of human rights are under the spotlight at the moment, and organizations are feeling the pressure to implement adequate strategies to address ESG issues and ensure successful implementation of those strategies, as well as the pressure to report transparently on ESG issues. The pressure for directors of companies to always consider sustainable and ethical profits while mitigating their negative impact on the earth and its people is also growing. Nowadays, we see stakeholders, including shareholders, investors, non-governmental and advocacy groups, zooming in on ESG issues and exploring alleged failures in environmental stewardship, social responsibility, and governance practices, exposing directors to allegations that they have breached their duty of care to the company. These advocacy groups are at liberty to pursue court action for alleged environmental violations, failure to disclose material ESG-related risks, human rights misconduct, and other labor violations by virtue of bringing class actions or derivative actions. One such case where an environmental law charity group instituted legal proceedings is the Client Earth versus Shell case in the UK. The group instituted legal proceedings against the directors of Shell and officers of Shell for breaching their duties, alleging a failure to adequately prepare for a net zero transition. So Client Earth have said the following on their website. I'm going to read the quote quickly. It says, in February 2023, we filed a case against Shell's board of directors for failing to move away from fossil fuels fast enough. This is the first ever case of its kind seeking to hold corporate directors personally liable. In May 2023, the UK High Court dismissed the case, and now our application to appeal the decision has been rejected. We are deeply disappointed by the Court of Appeal's refusal to hear our lawsuit against Shell's board of directors, which we think is wrong. This case was a world first, seeking to hold corporate directors personally liable, and a groundbreaking attempt to secure much needed clarification on the legal obligations of directors in a time of environmental crisis. End quote. In South Africa, when environmental authorities granted Eskom the environmental authority to construct a gas-to-power plant, two environmental justice organizations, the South Durban Community Environmental Alliance and the trustees of Groundwork Trust, lodged a review application against the decision to grant Eskom that environmental authorization based on a number of grounds. These included that upstream greenhouse gas emissions were not comprehensively considered, and there were shortcomings in the public participation process. The High Court dismissed this review application, but it granted ancillary orders to remedy the defects in the public participation process. So you can already see where the courts are going. In another groundbreaking case, the people of Xolobeni in the Eastern Cape lodged formal objections against a company called Transworld Energy and Mineral Resources. After it was, it lodged an objection to this company being granted permission to mine on the basis that the mining project would destroy the local environment and disrupt their way of life. They also informed the regional manager of the Department of Mineral Resources that they still had not received a copy of the mining right application. The community requested him to provide them with a copy and said that any confidential or financially sensitive information could be redacted. That community won this case in the Gauteng High Court, and it now enables communities to meaningfully consult with companies that want to conduct mining operations in their area. According to the judgment, the regional manager of the Department of Mineral Resources must provide a community who will be affected by a proposed mining operation with the information contained in a mining right application if the community requests that information. I see that this case was also used in ethical leadership courses at the University of Stellenbosch in some postgraduate programs. Well, it is clear that the ESG pillars are the thing to watch, and if anyone is unsure, please reach out to us at ENS. We have highly skilled lawyers who can assist in all things ESG related. So now I'm going to discuss also the legislation that also promotes awareness and encourage businesses to operate sustainably. We have the climate change bill, which is aimed at enabling the development of an effective climate change response and a long-term just transition into a low-carbon and climate-resilient economy and economy and society for South Africa. One of the objects of this legislation is to provide a coordinated and integrated response by the economy and society to climate change and its impacts. We also have the Carbon Tax Act, which was recently amended by the Taxation Laws Amendment Act of 2022. This Carbon Tax Act came into operation on 1 June 2019. It imposes a carbon tax on listed taxpayers under the Act, and it is aimed at making a contribution to the global effort to stabilize greenhouse concentrations in the atmosphere. We also have the Green Hydrogen Commercialization Strategy for South Africa. This one is currently in draft form and is dated 30 November 2022. But it's a document that was prompted by climate change. Then we have the adoption of the Just Transition Framework for South Africa, which puts South Africa on a path towards reaching climate change and development aspirations and ensuring progress towards the national goal of reaching climate resilience and a net zero carbon emission by 2050. Lastly, we also have the King report on corporate governance, which of course are voluntary principles, but they are widely recognized in South Africa. This report emphasizes and encourages transparency and responsible business practices, including environmental and social considerations. Ladies and gentlemen, in light of what we've discussed, ESG practices are becoming more and more embedded in our legal systems. And the intersection between ESG and other areas of law, like litigation, are becoming the areas that you need to watch. And again, if you are thinking about how to best implement ESG practices in your business, you can speak to any one of us here at ENS. We have highly skilled lawyers that are always ready to assist. Thank you very much.
Anyway, good afternoon, everybody. I'm here to spoil your fun because you've now been enthused and fired up to do all these great ESG initiatives, and now I'm going to tell you why you can't do that. Not that bad, but I am talking about the damper on the enthusiasm, or it can be a damper on the enthusiasm, particularly when industries collaborate, talking about competition law. So let me take you through some examples of, where, maybe just a step back, when we were thinking about the title for this talk, landed on when green conduct gets a red card, but it was a toss-up between that and the road to hell is paved with good intentions. Because the message that I'm going to try and give you today is to say, just beware with all these great initiatives that you may have. Just please take care and take a moment and look at whether there are competition law implications for your conduct, because if they are there, they are quite severe. So I've got 4 broad examples that I quickly want to run you through. One is if the financial services industry says, well, we think that in order to drive the agenda for ESG and for investment in green projects, etc., we think that we will give either a lower price or lower funding costs to green projects, or we will load our costs for carbon-intensive industries, etc. That could be one industry initiative to pursue the ESG agenda. Another ESG initiative could be grocery retailers that say we are going to try and reduce our footprint in terms of plastics, decrease our use of plastics. We will only use, we are come together as an industry and we say we will only use recycled and recyclable paper bags for grocery deliveries, for example. That's another example, laudable, and it sounds like quite a good initiative, don't we all agree? Then also, others, joint ventures by industries to say let's decrease our transport costs, let's go into joint ventures, our trucks are all going on the same roads, let's pool this together, set up a joint venture and take this forward into the world. And we will decrease the carbon emissions associated with our deliveries. These are all great initiatives and all great examples of ESG initiatives that in this world and in South Africa would potentially fall foul of the Competition Act. So I'm sorry to break the bad news to you, and I'll explain to you now why these initiatives fall foul, and then I'm also going to take you through some of the mitigating factors or some of the things that you can try to put in place to ensure that you don't fall foul of the Competition Act. And my question here is, why is competition law spoiling the ESG party? Why is competition law not playing ball with the green initiative? And for that, let's take a step back and say, what is competition law all about? And competition law is all about driving prices lower for consumers and giving consumers the choice that they may have, or the most choices available to them, given the resources that we have available in our economy. And the drafting of competition law took place, and then, the birth of competition law took place 130 years ago. Jocelyn and Justin are here, they'll keep me honest around that. The economic theory behind that is that free markets deliver the best outcomes and will drive prices down, so producers competing with each other for resources to produce inputs or to produce products will innovate and drive prices down so that actually we buy their products instead of the more expensive products. The problem with that is that in those markets we don't internalize the costs on the environment. It does not get internalized in the costs of the product. I think there's, with carbon taxes and those kind of things, that's the idea behind it, is to try and internalize those costs, but it hasn't been. So when companies, firms in an industry come together and say, well, we are going to internalize these costs now. We are going to actually say we're not using plastic packaging anymore. We are going to use more expensive, recyclable, renewable paper packaging. It will mean higher prices for consumers. Now, our Competition Act and most competition legislation across the world does not cater for that decision. And I can tell you now, willing to put some money on the bet, that our Competition Commission here in South Africa, if you say to them, well, actually, we as an industry had to get together and we had to decide that we are boycotting a certain input, or we are not going to use a certain supplier because they are not ESG friendly, that they will take a high likelihood that they will take a very legalistic approach to this and say, well, do you fall under Section 4.1b of the Competition Act, which I'll unpack in a moment. So just so that you are aware of the mindset as well, the culture that we have, particularly in South Africa. We see that it's starting to change in the rest of the world a little bit. And I'll talk about that a little bit later. But here in South Africa, the Commission sees that there is industry collaboration that has an effect on prices or trading terms, or it looks like customer allocation or anything like that, there will be trouble. Okay, so be warned. Are they scared enough yet, Jess? Do I need to? Look, okay, fine. Okay. So, how can this be challenged in the South African context? And I think what we need to maybe just appreciate for a moment, and I think I'm probably preaching to the converted, but it is very difficult for a single firm to go out and to roll out its environmental, its ESG initiatives, where those initiatives affects its cost base. It is most likely then going to be at a competitive disadvantage to its competitors. So there's a huge drive for collaboration in industries to ensure that you don't have the opposite of the first mover advantage, this first mover disadvantage. Particularly, I think, in a developed economy or developing economy like ours, where your customers are not necessarily sophisticated enough to say, well, actually, I realize that product B is more expensive than product A, but product A is detrimental to the environment and product B is not, and that's what I'm paying for. In low-income countries and low-income households, we'll worry about the environment next year. Now I'm worried about feeding my kids is the main driver there. So the necessity for collaboration, I think, is well recognized for ESG initiatives, but not necessarily the collaboration isn't necessarily absolved just because it has an ESG initiative or an ESG objective. Okay. So let's talk very, very briefly about Section 4.1b. That's our red card conduct under the Competition Act, and that is your what we call cartel conduct. It is price fixing, or the fixing of, all of these agreements must be between competitors. These can be actual competitors, so actual firms that provide substitute products to each other in markets, or potential competitors. So you may have, you may not yet be in the market, but may wish to enter a market. Then you could be a potential competitor as well. So your agreements in those instances would also fall to be assessed under Section 4.1b. So price fixing is outright what we know. We've all heard about the bread cartel in South Africa, and was actually, I see Justin smiling at me, it was actually not a price fixing, it was a trading term fixing because it fixed part of the trading, so it fixed the prices to distributors, margins that distributors could get. But that kind of conduct is per se prohibited in South Africa. You may not do that. When we say per se prohibited, it means that there is no defense to it. Okay, so you can't come around and say, well, actually I did this, but it is good for South Africa, the South African economy, or for development, or for employment, or anything like that. You don't have that defense. It's a tick box exercise. There is a rule around characterization, but I certainly wouldn't advise anybody to rely on the characterization rule for any conduct that could be seen as price fixing. Market allocation being these are your customers, these are mine, or I will only produce these kind of products and you produce those kind of products. So it could also be you do green products, I do non-green products. That could also be a market allocation and the like. Falling under the fixing of trading terms or price fixing is also what we call group boycotts or boycotts. So if an industry sets a standard and it says we will not trade with somebody that uses X product as an input, or we will blacklist Henry because we don't like the way he speaks to his colleagues or his clients, or whatever the case may be, that kind of blacklisting would also be a fixing of a trading term and would be per se prohibited. So we have seen in Europe, there have been examples where certain products, certain industries went out and said, well, we don't want to use those products. They are harmful to the environment, and we are, as an industry, deciding that we will not be using that product. As a fine line between that being a boycott and being a standard that gets set by the industry. I'll talk a little bit about that later. Okay, I mentioned joint ventures earlier. What can happen when you have joint ventures is that you take away the independent pricing of two parties, you pool resources, and instead of there being some competition in pricing and the outputs of what would previously been independently produced, that is eliminated, and the joint venture can then be seen as a mechanism through which prices are then fixed. So joint ventures, discuss that a little bit later as well. It very much depends on the way that it is structured, whether you trigger any competition law concerns on that road. Okay. All is not lost. Not every conduct by industries is seen as a red card. We also have some orange card stuff. So I've spoken to you about Section 4.1b. Section 4.1a says that agreements between competitors are prohibited if they lead to a substantial prevention or lessening of competition. So there must be some harm that comes from that conduct, and the substantial prevention or lessening of competition is generally consumers pay higher prices, there's fewer innovation, there's lower consumer choice. That would be a substantial prevention or lessening of competition. But even if there is a finding of this, what we call an SLC, even if there is that finding, you do have the opportunity to defend by saying, yes, but this conduct does give rise to certain efficiencies, technological gains, or other competitive gains. In my view, I think we can massage in the benefits that come from green initiatives, to massage that into the defense. But very importantly, we can't use that defense, this efficiency or technological or other pro-competitive gain, we can't use that if there is if pricing is actually affected, price inputs. But if it is just a case of pooling resources for the benefit of research and development, etc., that can be defended on that basis. Okay. And then there are also some green card conduct that is already, you'd be perfectly safe to do that, with a caveat that industry standards should not be used as a way to eliminate competition. If industry standards are set in an open and transparent manner, and firms are free to choose whether or not to comply with those industry standards, industry standards are generally given the green card. In other words, you can say, well, industry says, the building industry says that we will use X measurements, etc., etc. It reduces offcuts, it reduces, increases substitutability between products, all those kind of things. So it has a lower environmental footprint. Henry, being the rebel that he is, can then still say, well, actually, I'm not going to comply with those, so I will give the consumer the choice of not having the standardized product, etc. So standard setting, as long as it isn't used as a mechanism to boycott, can be absolutely permissible. And standard setting, it's a topic all on its own, actually. But standard setting is also a great way, again, for an industry to signal its intentions. Signaling, very often, also in competition law, has a negative context to it, in that it is basically just a way to agree on certain competitive metrics, but standard setting isn't necessarily there. Information sharing between industry participants, as long as it's not competitively sensitive information, such as your prices, your input costs, and your customer lists, and those kind of things. Information sharing can be, pass muster and get a green card. The type of information that you can share, for example, is the information about Henry's bad behavior. Sorry, Henry, I mean, you're just such a rebel. What can you say?
Just sitting here, man.
Just hammering. Anyway, if we share that, as long as we don't agree that it's a boycott and we each independently decide that we're going to boycott Henry, that's okay. But agreements, so agreements that don't affect pricing, that don't directly affect pricing, directly affect the value composition of a product, or allocate markets, etc. Those are generally agreements that are seen to be fine. Internal conduct agreements. So for an industry to, for example, say, so if law firms decided that they were going to go paperless, for example. Our ESG initiative is we are aiming to be paperless by 2025, that kind of thing. We don't sell paper, we're not boycotting paper, we're not using paper as the, and that wouldn't necessarily go as count as anti-competitive conduct. Okay. I'm about a third through now. No, just kidding. Okay, so I've mentioned some examples of red card conduct. I just want to give you a couple more. I always find that it's easier to internalize some of the knowledge if you have some examples. Joint production, joint marketing, that's a no-no, even if it is with the aim of pursuing ESG objectives. Joint purchasing. Now this is one that personally I feel shouldn't be a per se prohibition, but it is, so we need to deal with it because it can actually, and I think in many instances, be pro-competitive. So in instances where, to save costs, save on shipments, deliveries, all those kind of indirect costs, parties can say, well, let's pool our requirements, particularly for imported products and the like. But that is generally seen, it's just a different kind of price fixing arrangement. It's a purchase price fixing arrangement. So that also has received some attention in the EU. And interestingly enough, in the EU, they don't have the per se prohibitions like we have there. Everything there is rule of reason. So even in those circumstances where there were very pertinent good intentions behind the conduct, it also got some negative attention from the European Commission. I mentioned information exchanges as being fine, but information exchanges with regards to competitively sensitive information, prices, your production processes, your customer lists, those kind of things are not permitted. And I think what we see in the conduct that or the way that the European Union, the European Commission has reacted to this is a large skepticism towards the collaboration between competitors. So you will be on the back foot to say, but this is necessary to pursue, and they will be skeptical about it. It's not just, oh great, you've got a green initiative, so off you go, do your thing. The other thing was, and this was actually got a lot of attention, the standardization. So I just said standard settings are fine, but the standardization of CO2 emissions was seen to be an actual problem in terms of reducing consumer choice and being used as a buffer for price increases, it limits price competition, because now everybody says, well, actually, it's going to cost us 2 or 5% more to manufacture our product, so don't worry about that. We are safe in that buffer that everybody's going to charge a little bit more because of this, this agreement to reduce CO2 emissions. And then the other one that I have mentioned already is group boycotts got some negative publicity and negative attention from the European Commission. So how do we overcome red card conduct if we have that? If we say, well, we are industry X, this is important, this is necessary for us to do so that we can ensure a sustainable industry in South Africa. What do we have in our back pocket to go to the competition authorities and say, please allow us to do this? Okay, and what we have is an exemption from anti-competitive. We can apply to be exempt from the application of the Act to your anti-competitive conduct, whether it has anti-competitive effect or not. But there are limited grounds upon which you can do this. And the most relevant in our context will be either for efficiency gains and the promotion of employment or industrial expansion. There are others, promotion of exports. So if you are in an export industry, you can use that to say, well, by agreeing as grape manufacturers that we will not use X chemical, the European market opens up for us, et cetera, et cetera. Another ground for exemption is to change the productive capacity in a market. So I think they basically link as well to exports or the decline of an industry, is that without adjusting as an industry, and we actually have to do this as an industry because we won't get away, it won't happen if we had to do this each individually. We have to operate in a certain manner. So obviously ESG objectives can contribute to these factors, and you can let's go to the Competition Commission and say, but very importantly, if you do apply for an exemption, it is saying, I am going to contravene the Competition Act. You can't say, I may be, and maybe this is, we used to do that in the old days. We used to say, out of an abundance of caution, we are bringing this to you so that you can exempt us from the act. If it is a contravention of the Competition Act, they're like, nah, you can't. If you think it's not a contravention, don't come for an exemption. If you think it's a contravention, put it on a piece of paper and say, I think it's a contravention, and please exempt us from the application of the Competition Act. So it's a bit of a rock and a hard place, that one, but a bit unfair, I actually think. So that avenue is open. So it's not a case of you may not collaborate as an industry at all, but there are certain limited grounds on which you can go for a place. I'm going to deal. I don't think. Let me just use one sentence because Jess is glaring at me. Talk too much, sorry, Jess. So just in terms of mergers, just so that you are aware, and what happens in mergers flows through in the competition authorities. It flows through in terms of their thinking, etc. And what we have seen is is that in terms of assessing the public interest in mergers, ESG is starting to play a role in two ways. The one is that merging parties say this is a pro-competitive, this is a positive merger because actually there are these ESG objectives. By merging, we will be able to pool our resources, and our intention is to develop X, Y, and Z, or we will reduce our carbon emissions by 30% with the pooled resources that we blah, blah, blah. Those kind of things. That's the one thing. So it's to motivate for that merger outright. And the other thing is we've had it's recent, it's 2019, it does feel like yesterday, but it isn't. But a recent amendment to the Act where there's a fifth public interest factor to consider, and that factor has been interpreted to put a positive obligation on merging parties to improve the HDB or worker ownership in the merging parties, or the merger must increase HDP or worker ownership in South Africa. Now that's very often very difficult due to commercial and structural reasons. It's very difficult to do. And what the Commission has then said is, well, you've got to make a positive contribution somehow through this merger. We can't just let you off by not having a negative effect or and one of the cases was an IT company that then had to they undertook, but they were basically forced to undertake to put up solar energy or solar panels at schools, at certain schools in South Africa. So their thinking is, well, using ESG and ESG objectives as a way to make positive contributions to South Africa. So that is helpful. Worldwide, the European Union very sensitive to ESG. I think it's papers by the European Commission on how they will approach these kind of collaborations and when they will want to have a closer look and when not. America, the total opposite. America, it's been used as a political tool. There have been industries that have said, okay, let's collaborate, let's do this, and let's make some progress. And what you've seen is that other related industries, or just industries with political agendas that believe in freer market economies with limited interference by government, have then gone to say, well, that's actually anti-competitive. It's and it shouldn't be allowed. These kind of collaborations shouldn't be allowed. So it's being used as going in the wrong way. But I don't know, I sort of think that's America at the moment. In Africa, what we've seen is COMESA has, in its amended regulations, brought in ESG considerations as an outright consideration in its assessment. So that's quite a positive development. So, in conclusion, I'm allowed to say in conclusion, or should I just conclude? No. Oh. No, I'm just kidding. There's no clear guidance in South African law about where green conduct will get or won't get a red card. It will be assessed like any other conduct and any other coordinated conduct. It will be assessed, and if it is a Section 4.1b or falls to be assessed against Section 4.1b, I think you can expect very little sympathy from the competition authorities. But all is not lost. There is the exemption route to take, and there is an increased, in our view, an increased sensitivity to ESG factors. So from that perspective, we do think that engaging with the competition authorities before things get out of hand would probably soften their approach that they take to this. So parting message is it's not easy, and it's not easy to know exactly when you are going to run into trouble, but that's what we are here for, to advise you on that, and navigate it carefully, and feel free to reach out.